It's going to be a volatile year, and there's going to be a lot of uncertainty there.
All of that policy change is out there for us to sort of take and accept, but I do think it's out there and it is positive in terms of where it's heading.
We don't see inflation accelerating from here like other people. Inflation is going to be demand-driven. I just don't see enough demand.
More towards the cautious side, not the optimistic side.
There are a lot of things out there that I think are going to be adding to volatility, but I don't think that we're headed for a deep correction or a new bear market.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning. For our audience worldwide, Bloomberg Surveillance starts right now as we come into Tuesday, looking for just a little bit more relief in the equity market and to build on yesterday's turnaround. Equity futures positive by, let's call it 0.5% on the S&P, up by close to 0.7 on the Nasdaq 100. The bigger gains are actually coming from abroad, in Europe, in China. On the Euro Stoxx 50, we advanced by about 1 full percentage point. Overnight in China, up by 2.6%. The why? Bit of dollar weakness in the mix. The why again? This story right here from Bloomberg. According to people familiar with the matter, key members of President-elect Donald Trump's incoming economic team discussing slowly ramping up tariffs month by month.
And Anne-Marie will tell you, we have been talking about this for so long, and she will talk about how we've talked directly about this with individuals that are coming into the Trump administration, and that this is actually just a proposal. It hasn't necessarily even been presented to Donald Trump, which raises the question, are we adequately pricing in just how much volatility there is going to be around the hearings this week, let alone the week after, and all of these different policies that are potentially going to whip around global markets?
I was in Palm Beach this weekend, and one thing that stood out to me is the foreign policy and even potentially the trade approach of Donald Trump is going to be summed up in one word: unpredictable. On purpose. There's an element that Donald Trump wants in terms of keeping adversaries and maybe sometimes some of their allies on their toes. But what this story says to me is that Scott Bessent and his wing of the cabinet is winning out at this moment. It's the sausage making in real time.
So we've had 3 different versions of this story over the last 2 weeks or so. We had one from the Washington Post, another from CNN, and another from the team here at Bloomberg. And they all acknowledge that they haven't actually crossed the desk of the President-elect Donald Trump just yet. But I think this one is important. Scott Bessent said this on this program back in the summer. When he was in the running to become the Treasury Secretary, he talked about taking an approach which really lent towards negotiating with a partner. I think that is really important. Another important factor of this is the objective: to put a lid on the prospect of inflation increasing. That tells you they're sensitive about that as they're coming into power.
At a time where even J.D. Vance is talking about bond yields, I would add another element to this, and I think that that is very well said, and that is I wonder how much markets are actually going to be a check on the president. Is this not only a rehearsal for Scott Bessent and what he's going to be presenting to the president, but also a rehearsal of the market's reaction to competing proposals and how it will be taken in markets?
When Scott Bessent was an advisor before he got tapped to become the incoming Treasury Secretary, he was a little bit more loose with his words, obviously, because he could be. And he talked about Trump. We pushed him on this idea of a tariff ring around the United States. He said that is an opening gambit. That is the maximalist approach. His idea was 2 to 5% every month. Xi Jinping, call us when it starts to bite.
Got a new question as well. Does Elon Musk get TikTok? Check this out from the team here at Bloomberg. Chinese officials evaluating a potential option that involves Elon Musk acquiring the US operations of TikTok if the company fails to fend off the controversial ban of the short video app. You're raising your eyebrows to this one. What did you make of that report?
Number one, does that mean that they're going to lower the price and basically sell it to Elon Musk as a fire sale is basically a token of their goodwill because they also have a good relationship with Elon Musk, with Tesla in China? Is this essentially becoming a state negotiating tool, or is this actually about ownership of TikTok? And number two, is this a sort of concession that China is willing to sell it at all, which is sort of interesting ahead of where all teenagers are freaking out because TikTok is going to get banned on January 19th?
I think we can learn a lot from this story, and you brought up a good point. Is now this a point of leverage for the Chinese government to use with the Trump administration? And clearly they would choose someone like Elon Musk, who is the self-proclaimed first buddy, but also someone they know because of his work and dealings with China and Tesla. Can he do this deal alone? I talked to a source yesterday, and what I'm hearing is that there's lots of other people that are also interested in this. Does he team up with someone like Meta? And what kind of antitrust rules could potentially come into play, given the fact that they already own social media apps?
More on that story a little bit later. Equity futures right now on the S&P positive by 0.5%, bouncing back. We'll see if this move sticks. Joining us through the next 60 minutes, Stuart Kaiser of Citi, seeing rising bond yields as a positive for equities. Terry Haines of Pangaea Policy, as Trump's team considers a gradual approach to tariffs. And Matt Luzzetti of Deutsche Bank calling for no rate cuts this year. We begin this hour with stocks rising and the dollar weakening following a Bloomberg report that President-elect Donald Trump's team is considering a gradual ramp-up in tariffs aimed at boosting negotiating leverage and avoiding a spike in inflation. Joining us now, Stuart Kaiser of Citi. Stu, good morning to you, sir.
Good morning.
It's good to see you. What did you make of that report? How were you thinking about the trade approach from the incoming administration?
I mean, I don't want to call it best case, but that's what the market's hoping for, right? Is kind of a more rational, kind of gradual approach to this. I think one of the reasons markets have been a little weak to start the year is I think people are a little concerned about what next week's going to look like. What kind of headline risk do we face? And if you're getting things that seem a little bit more measured and balanced, I think that's probably a net positive for risk sentiment.
The source of the weakness has come from the bond market. You've been focusing on the why. You've said a million times that higher yields, I'll take that, so long as it means it's underpinned by stronger growth. Is inflation a factor in this boost in yields that we've seen?
It's hard to kind of tease out, but if you look at the move in 10 years, let's say the 10 years up 40 basis points or so in the last month, real yields are 30 basis points of that, break even's about 10. So that quick and dirty would say about a quarter of the move has come from the inflation side of the ledger. But I think if you were weighing the risks, more of the risk aspect, I think, has come from the inflation side of things. But yeah, I think from our perspective, as you know, I think a 5 handle on 10 years is better than a 3 handle on 10 years if you're an equity investor, because to get back down to that 3 level, you really need weak growth. So, definitely don't want to completely dismiss the risks of the speed of the move we've seen in the 10-year yield, but we do think it's coming from a more positive place than maybe the markets are giving it credit for.
Which raises a question: which are the areas that are most sensitive to higher rates? In other words, the other way to say this is, which are the least sensitive to it and can still continue to lead performance at a time when there are worries about longer-term borrowing costs and what this does to, say, small caps and mid caps and the like?
Look, I think there's a couple beneficiaries. One's banks, and people already love banks, so that's been rather convenient. I think other areas, people are probably a little more comfortable in a safer credit risk kind of equity. So your kind of larger cap stocks have benefited a little bit. Last week was really interesting because what you kind of saw is everything sold off, but like the equal weighted S&P outperformed the cap weighted S&P. So people kind of wanted to still be in large cap, but they also moved a little bit down the cap structure. I think what you're seeing there is a trade-off between I want to be in some more value stocks because value benefits from higher yields, but I don't want to go all the way down to that small cap stock quite yet. So people kind of moved a little bit down, they hit a fence and they stopped. And that fence seems to be around the top 500 U.S. stocks. So what's benefiting is banks and its value mainly. But I think that move has been limited by the fact that people are still a little bit concerned about what's going on in the background, and they kind of want to still stay a little bit higher in the quality spectrum if they can. Some
of the main drivers of growth have been big tech, right, for a number of years. And yesterday we saw an interesting development, an ongoing development over the past week, which is NVIDIA and Apple really selling off pretty significantly. There's some conflation here that it's tied to yields. There's some conflation that it's maybe tied to policy. What's sort of the main driver? How do you view this at a time where a lot of people view that as the ongoing ballast of market performance?
And we would agree with that. I mean, I think if you look at earnings growth this year, S&P's at 15%, Mag 7's forecast to earnings more than 20%. So that's still kind of the core driver of your earnings growth story in the U.S. I think what you're seeing there and what you've seen for the last few quarters is going into the quarter, there tends to be, even within the Mag 7, a couple favorites and a couple kind of less favorites. And it could be that, the product cycle on the Apple side maybe is not convincing people. NVIDIA, I mean, their leadership was basically in a headline war with the Biden administration last week. So, there's clearly some policy risks that are going on there. So this is probably, in my view, those things that perform so well. You're going into an earnings season. You do have some policy risks on the sides, and that kind of maybe gives people a little bit of a trim up on risk ahead of earnings and the inauguration.
Stuart, you sound very constructive about growth, but the fact of the matter is, if we're in this moment of so much unpredictability and whipsawing sometimes of headlines that are pushing markets around, that in itself, can that hurt growth? Could it mean paralysis for some businesses?
I think it definitely could. And the flip side of that argument, if you want to come up with one, is if I'm worried about tariffs, I'm going to front load my inventory cycle and I'm going to get some stuff done now. But yes, I mean, obviously the policy uncertainty can kind of play into what CEOs are feeling and thinking, because if you believe the Trump positive growth impulse, a lot of that is just somewhat blind faith that he's going to be positive for the business community, right? He's going to deregulate. He's going to give us more clarity. He's going to allow businesses to kind of invest for the medium to long term. But I agree with you. I mean, a lot of PMs have told us, I'm going to run long the dollar. I'm going to run long risk up until about the inauguration, because I'm not exactly sure what next week is going to look like. And for that reason, I need to be a little bit careful on how I manage risk. So, yeah, I think it can be.
So what do people do next week after January 20th?
I think a lot of it's going to have to do with the headlines. I think if you get a more gradualist approach on some of this stuff, going into earnings, people are going to be more comfortable having risk on. I think if you get a full bore, hardcore on the tariff side and very disruptive, then people are going to pull back on risk. And it's interesting next week, there's not a lot of specific event risk priced in for the inauguration. That's also a holiday, obviously. But the rest of the week is at a modest premium to the rest of the month, if that makes sense. So people are not sure when the news is going to come and what it's going to look like. But they're basically saying, OK, fine, from Tuesday to Friday, I need to add 8 or 10 basis points of implied move into the vol market, because I'm just not sure how this is going to come out. And I agree with you. I mean, the uncertainty aspect and the effect on business is real. And I think actually we saw that during the Biden administration as well.
I think we all know we're going to get a string of executive orders at some point in the next week or so. We just don't know on what and how much of it we're going to get. Lisa, it's been a fascinating change, though. In early November, we all talked about this positive growth shock for financial markets that we needed to digest. Bond yields were higher. Equities were up alongside them. That correlation has just totally broken down coming into the new year. And if you looked at equities at one point yesterday, we completely wiped out the post-election Trump bump, just like that.
This is also, though, coming when the rise in yields isn't just completely, indisputably a positive thing coming on the heels of growth. Real yields, which is basically the yield term premium, have increased dramatically, particularly at the long end, which raises a question about deficit concerns and how much supply is as much of a part of that yield rise as growth is.
And unlike the Washington Post story that talked about tariffs, we have yet to see a truth or a tweet that this one is wrong. And I wonder if that is because Trump is recognizing that the markets don't like the tough talk on tariffs right now.
Give him a chance. And those tweets and those posts carry a little bit more weight from next week. Stuart, it's good to see you.
Thank you.
Stuart Kaiser of Citi there. Equities at the moment, as I say, positive by 0.5%. Busy week kicks off a little bit later this morning. We will get PPI, then tomorrow morning we will get CPI, and then the bank earnings tomorrow morning. Tons of them on Wednesday, a few more on Thursday. With an update on stories elsewhere this morning, let's get to your Bloomberg brief and cross over to Danny Berger. Hey, Danny.
Hey, John. Southern California faces another round of dangerous fire weather. The U.S. Storm Prediction Center warned of wind gusts exceeding 50 miles per hour through tomorrow. The winds may limit opportunities for firefighters to make progress against the Palisades and Eaton fires from the ground and the air. The blazes have scorched nearly 40,000 acres and leveled entire neighborhoods from the Pacific Palisades on the coast to Altadena at the feet of the San Gabriel Mountains. Joe Biden and Donald Trump both say that they are optimistic about a ceasefire between Israel and Hamas. The leader said a deal could be agreed to within days, pausing the more than 15-month-old war in Gaza. Israeli officials said that they presented a detailed outline to Hamas during indirect talks in Doha. Sources say the first phase would involve a 42-day ceasefire and the release of 33 Israeli hostages in exchange for Palestinian prisoners. Starbucks rolling out a new code of conduct across its cafes across North America. The coffee chain is reversing a policy that allowed anyone to use its cafes, patios, and restrooms, regardless of whether they made a purchase. The company is also reintroducing ceramic mugs and expanding its free refill policy for non-rewards members. And that's your brief. John.
Danny, thank you. Appreciate it. More from Danny in 30 minutes' time. Up next on the program, the tariff agenda taking shape.
Tariffs cause a stronger dollar, so a weaker dollar with tariffs is it's an economic abnormality.
There would be income from the tariffs, so that's a big number.
That conversation up next, live from New York this morning. Good morning. Stocks positive here by 0.5% on the S&P 500. Bond yields contained for now. We'll see if this sticks. Your 10-year 478, your next stop later this morning. PPI data in America, the appetizer for the big one tomorrow morning. CPI just around the corner. And the surveillance this morning, the tariff agenda is very much taking shape. Here's the latest this morning. President-elect Donald Trump's economic team weighing a gradual approach to its tariff policy, ramping up the levies month by month to boost negotiating leverage and avoid a spike in inflation. Terry Haines of Pangaea Policy writing, markets likely are hit with downside reality as it becomes even clearer that tariffs won't be all one or the other. Neither all blustery overkill nor all gradualist bark with little bite, but a mix of the tactical and overblown focused and not. Terry joins us now for more after that very helpful quote. Terry, welcome to the programme, sir. How much weight then do you put on our reporting this morning? The Trump team is putting this together. The president-elect himself hasn't looked over it. What do you think he'll actually decide on?
I think you've judged it, and your reporting has judged it appropriately. This is in the early stages. Trump hasn't signed off, et cetera, et cetera. As the quote you put up indicates, I've been on more on Team Gradual for quite some time. But I think what will end up happening is that the blustery rhetoric will ramp up to, frankly, to obscure the relative gradualness of, there's another one, right? Relative gradualness coming in. And also I note that in your reporting that the word emergency is used, an economic emergency. And I've been telling markets for, I think, since before the election, but certainly in the last 2 months, to look for Trump using more aggressively emergency powers. And I think that'll discomfort markets some. They've been soft-pedaled by the previous administration. And Trump, for good or ill, is going to be much blunter about where we are geopolitically and economically.
Terry, when you look at our reporting, and you really coined the term the cabinet of rivals, would you say that Scott Bessent and Kevin Hassett are the ones that are winning out?
I certainly think they're doing everything they can to win out, including putting things in the press. The thing I would caution, though, is markets tend to make the same mistake over and over about Washington. The same mistake here is assuming the Treasury Secretary will go tackle the president and make sure that he doesn't do anything crazy. That's exactly where markets were 4 years ago with Janet Yellen. They thought that Yellen was going to be the centrist that took the progressive edges off what Biden had made deals on with his progressive wing on, and that turned out very much not to be the case. But
Terry, if I could just interrupt you for a second, Janet Yellen is not Scott Bessent. Janet Yellen did not come in with a relationship that Scott Bessent has had for years with President-elect Trump. And at the end of the day, what we saw from Trump 1.0 is that he was regulated by the stock market. You would see some reports leaked, but then quickly changed because of the reaction of that leak report to the stock market. Do you still think potentially Trump 2.0 is going to be regulated by where the Dow Jones Industrial Average is trading at any day?
Oh, I think Trump will be very influenced by what the markets think about what he's trying to do. At the same time, I think what's going to end up happening is, markets always think that means they have the whip hand over Trump. I don't think that's the case, particularly as it goes to the geopolitics. And geopolitical concerns are going to play a much bigger role in this, in the economic views of this administration than they did the first time out.
In the meantime, people are looking to January 20th as the real event risk. That's what we were just hearing from Stuart Risk. And when I say people, I'm talking about people and markets. What kind of risk or sort of illumination do you think we're going to get this week with some of the hearings down in Washington, D.C. to confirm some of the potential nominees?
Well, I think people have been sitting in the markets, have been sitting around for over 2 months now, wondering what it is that Trump's going to do, and they will certainly get some illumination over the next few days. I expect the Senate to question Secretary-designate Bessent very closely on exactly what the administration policy is going to be on day one and going forward, and talk about a lot of the linkages that you brought up in the Bessent clips coming into this segment, how he feels about strong versus weak dollar, how tariffs are going to play into that, and frankly, what his relationship with the president is going to be.
Do you think that that's really going to be the most seminal hearing, or do you think that potentially there are others, whether it's Pam Bondi or whether it's even OMB nominee Russell Voigt, who has some pretty radical proposals for how to adjust the budget in the United States?
I think Bessent by far is the most immediate impact on the markets, but I think that the OMB hearing will have a lot of impact as well, frankly, because one of the things, the big thing I see lurking out there for markets in the negative is what the Trump administration is going to do about fiscal debt and deficit and whether it can do anything. We're in a world right now where debt service is the biggest expenditure, where nobody's got the political will to do anything about fiscal debt and deficit. And you've got a lot of counter pressure building, not only ramping up defense spending, but the LA wildfires alone and the estimates of how much money that's going to take, will play a major role in what tax cuts look like and what the fiscal policy looks like.
Terry, do any of Trump's picks not get through?
Yes.
Who?
I think I don't have one that is absolutely doesn't make it, but I think Hegseth has a very tough time. I think Gabbard has a very tough time. I think Bob Kennedy still has a tough time.
But wouldn't we know at this point, especially for someone like Pete Hegseth? I mean, his hearing is just in a few hours. Why go through with it if they didn't think that they have the votes?
Well, they don't know whether they do or not, frankly, so it's a little bit of a dice roll. But, the thing with Hegseth is that this will be an interesting test, Hegseth, of the seriousness of Trump defense policy. You put somebody in there who, as Hegseth says in his opening statement, apparently is a change agent more than anything else. That's fine. But the concern that comes from the Senate fundamentally is, change agents can't run bureaucracies, can't run the department, can't direct things in a particular way efficiently and effectively. So that's a lot of the problem with Hegseth, frankly, and what we're going to see with Hegseth really is a commitment to Trump defense policy and exactly what that is, frankly.
Hey, Terry, appreciate your time. Terry Haines of Pangaea Policy there on the latest down in Washington. There are going to be a couple of contentious hearings in the next several weeks, and that one in a few hours' time is going to be one of them.
It absolutely is going to be contentious when it comes to Pete Hegseth, and Axios has his statement in full, and he's talking about this idea of warrior and this idea of coming back into the Pentagon. When he speaks today, Pete Hegseth, I think you need to remember this was an individual who was on combat tours. So he'll be speaking to those men and women that are on the front lines.
It's also going to be interesting to see how much pushback Donald Trump gets from fellow Republicans. You talk about how everyone is a Joe Manchin, or at least the role that Joe Manchin played to Joe Biden. Everyone will be that, basically, to President-elect Donald Trump. It just raises this question. Is this market adequately pricing in the potential risks when you have the dual threats of basically upside surprise to inflation with some potential proposals and an expansion of the budget, or downside surprise with a more stringent use of tariffs and some other potential trade protocol? This is the reason why there's this jumpiness on any headline, and we've seen that this week.
I saw a ton of notes yesterday from fixed income strategists saying, don't try and fade this move in the bond market, don't touch it. I've heard a lot of people on this programme talk about the prospect of high yields because of trade worries. Then Deutsche Bank came out yesterday and said break-evens are still not pricing tariff risk appropriately. So there are some people who believe that this run-up in yield so far has nothing to do with the risk around trade, because the risk around trade is not clear at all.
Yeah, the head of the IMF, Kristalina Georgieva, is talking about how this is even the threat of tariffs is causing this backup in yields. However, if you take a look at real yields, basically inflation stripped out, the idea of some term premium baked in, 30-year Treasury real yields have risen to the highest since 2008. This is something else that's driving that, and I think that has to be recognized.
Looking ahead to some very interesting hearings through the next couple of weeks. Watch out for Hegseth, fantastic broadcaster. The presentation's going to be very, very good here. The back and forth, that guy's sharp. It's going to be fast.
He's a professional
at
presenting. So it's going to be, I think it's going to be contentious, but he will come prepared.
One to watch a little bit later. One to watch up next on the programme, Dan Ives of Wedbush on the chances that TikTok US could be sold to Elon Musk with China's blessing. We'll get into that in just a moment. Equity futures this morning, positive by 0.4% on the S&P. The dollar, just a little bit weaker. The euro, a little bit stronger. Euro dollar 102.57. Big turnaround in the stock market yesterday. Let's see if we get some positive follow-through. So far, so good. Equities up by 0.4 on the S&P, up by 0.5 on the Nasdaq 100. In the bond market, 2-year, 10-year, 30-year, shaping up as follows. Check out the 10-year maturity. Yields just about unchanged. 478.21. I mentioned some commentary coming from the South Side. Fixed income strategists yesterday saying don't touch this. Barclays, we believe it's a bit early to fade the long end sell-off. BMO, we won't attempt, Lisa, to fight the move.
At a certain point, how much are they conditioned by the past couple of weeks? Basically, anyone who's tried to fade this has gotten their face ripped off. It's been a very difficult one. I will say there is this difficulty of what's driving it, right? You pointed to this idea that Deutsche Bank pointed to, which was that basically it's not on rising inflation expectations necessarily, putting aside the University of Michigan sentiment survey. But if it's coming from growth, that's a positive. U.S. small business optimism just came out at the highest level going back to 2018. There are a lot of facets to this, some good, some bad.
Self-correcting, self-limiting, afraid we've heard on repeat over the past week or so. Goldman had this to say in the past week. We don't think the yield move has yet reached the point of becoming self-correcting. To your point on the economic data, where is it going to be self-limiting? In the markets? Have you seen enough damage to risk yet? In the economy, the data still looks pretty decent, soft and hard.
So it goes to this ultimate question, which is, are rates restrictive? And Matt Luzzetti, Bank of America, coming out and basically saying no. They're going to take a sabbatical this year because essentially this is not showing restrictiveness anywhere. And it goes to the idea of, are these rates sustainable? So don't buy this dip because this is the new reality and companies are doing just fine.
Matt Luzzetti of Deutsche Bank coming up a little bit later this morning. Look out for that. Just want to finish on foreign exchange. The dollar a bit weaker today. Euro stronger. Euro dollar was totally unchanged in yesterday's session. Euro dollar this morning, 102.59, positive by close to 0.1%. Under surveillance this morning, Southern California bracing for another round of dangerous winds as firefighters struggle to contain fires across the region. Winds exceeding 50 miles per hour are possible across Los Angeles and Ventura counties today into tomorrow.
It's really tragic, and people are looking at this. There is some insight into what potentially caused it, including some fireworks during the new year that never were fully put out, which is one of the potential consequences of very dry weather. Now the question is, how do you pay for it? How do you recover? And then the politics, which have gone back and forth and gotten pretty aggressive.
The politics will be one thing, but putting that aside, how much this is going to cost? A report last night coming out, new estimates from Wells Fargo and Goldman says that a significantly exceeding the prediction that already we had last week. I mean, we are talking about now as much as $30 billion. And this is before potentially these fresh winds and fresh fires. This can be a lot more expensive than even that.
The rebuild effort and the cost of it is going to be absolutely massive. This is not the only issue that we have to face. We've also got the hurricanes and the recovery in several states across the southeast that we were talking about only several months ago. They're still in a mess down there too.
So this goes to the point that Terry Haines was talking about. At a time where you have additional costs that are going to be incurred with different natural disasters that are coming with increasing frequency, how do you do that? What kind of fiscal space do you have to do that if you're already contending with a deficit and higher benchmark yields?
Well, this is why Speaker McCarthy last week said to me, you have to come out of the gate and say, declare a disaster for California, put money towards there and also the border, and then do one reconciliation package. And he thinks that gives them a little bit more wiggle room and fiscal space to do so.
We'll focus on the rebuild effort a little bit later this morning. Wanted to bring you an update on the latest story moving markets. Bloomberg reporting that President-elect Donald Trump's team is considering a gradual ramp-up in tariffs aimed at boosting negotiating leverage and avoiding a spike in inflation. Sources saying one idea involves tariffs increasing by about 2 to 5% each month.
Not really surprised about this because Scott Bessent on this program, when he was an advisor to President-elect Trump months before the election, said this is how he using tariffs. This idea that you call Xi Jinping up and you say, we're going to put on tariffs every single month. It's going to add another 2, 3, 4, 5%. Let us know when they start to hurt and you're willing to come to the table and do a deal. What I think a lot of members of the incoming Trump administration will say to you is that Trump is not against trade, but he wants a realignment to make sure that the trade is fair. And right now, they do not think that China is playing by the rules.
How much is this basically different advisors petitioning the markets and figuring out, look, I'm going to do an audition, see how this reads through into the market. And Trump, this is the response. So which do you want? And I wonder how much that's sort of an element here as well.
I don't know which advisors were behind the Washington Post story or the CNN story for that matter. I do think it's important that these are key economic advisors. This is Hassett. This is Besson. They're going to be the key players in this administration. Whether the president listens to them or not is going to be the key factor in all of this. And that's why you're all sort of in this new world right now, the old world of Trump Volume 1. You have to wait to hear what the incoming president has to say on the issue himself.
Absolutely. He's going to be the final decision maker, but he will convene all of these people, as Terry Haines have called them, a cabinet arrivals. You're going to have those that are a little bit more outspoken about tariffs. I'm thinking of Howard Lutnick.
Sure.
You're going to have those like Jameson Greer that thinks we need an absolute full decoupling from China. And then you're going to have others that want to take a little bit more of a nuanced approach, like Scott Besson and Kevin Hassett.
Lots to get through this morning, including this story as well. Chinese officials evaluating the potential sale of TikTok's US operations to Elon Musk. Sources telling Bloomberg that under one scenario being discussed, Musk's ex would take control of TikTok US and run the businesses together. TikTok denied the report, calling it pure fiction.
Well, TikTok still wants to remain autonomous in the United States. They do not want to divest. What is so interesting is ByteDance even aware that Chinese officials are having this conversation and basically handpicking who they deem respectable in their minds to take on this company? Based off what I'm hearing, there are other people who are also interested in potentially buying TikTok. I would look to the likes of individuals like, well, Kevin O'Leary posted it on Twitter, but even other people like Peter Thiel. Where is he in all of this? Where is Mark Zuckerberg, who's made now a few trips to have dinner with the president-elect, and then went on Rogan and said, we need to make sure that U.S. data, U.S. tech stays in outside hands of governments, especially our adversaries. What I find so interesting is, one, why is the Chinese government handpicking who they want to control this company? And two, if it is sold, do they get the algorithm or do they need to develop their own?
We're a private company. There's no national security risk here. There's some separation between us and the Chinese government. Chinese officials turn around and say, this is who you could be sold to. What does that tell you about the situation?
That this is being used as a carrot in negotiations. And I think that that is a change in terms of what's national security, what end up as being a negotiating tool. That's one thing that people are going to be looking at. Let's stick with TikTok. Dan Ives of Wedbush weighing in on the looming ban, writing the following. There is much more at stake here than just TikTok's fate, as the US-China high-tensions relationship are clearly at play, heading into a very important tariff discussion and negotiations for the Trump administration in the months ahead. Dan joins us now for more. Dan, welcome to the programme, sir. Just want to start with your reaction to our reporting overnight. What do you think?
I think it makes a lot of sense. I mean, ultimately, it comes down to this 19th that's coming around in terms of January 19th. The Supreme Court ultimately upholds that ban. Behind the scenes, Trump administration working to sort of look at fixes. And I think when you look where Musk is in terms of just how close to Trump, they also trusted within China. This looks like what could be a strategic road for ByteDance, that they'd sell this without the algorithm.
So what does this mean about either national security or potential tit for tat? What's being used, the sort of conflation of public and private in a new way that, frankly, the business community has to reckon with?
Yeah, I mean, look, I think, Lisa, the issue here is the last thing that Trump administration wants is this to come out day before inauguration. Because it does sort of set this off to a bad start in terms of negotiations with China on tariffs. That's why I think they're looking for ways, instead of just basically telling the DOJ not to enforce these actions when it comes to Google, Apple, and others. It would be a lot easier if the Supreme Court ultimately upholds the ban, that Musk, just given the ownership of X, given obviously the strong understanding of China and the relationship, within Beijing, this could be a first step. But it's going to be something we've talked about on the program. This strong alliance, the bromance between Trump and Musk, is going to have a lot of sort of twists and turns. This could be the first start.
It raises a lot of questions here also about antitrust and what's acceptable among social media tie-ups and what's not. Is this just a matter of who gets closest to Donald Trump is sort of okay to be able to make these types of tie-ups, and those who are not are basically on the outside and won't have access to any potential acquisitions?
Yeah, and look, you're seeing that there's sort of red carpet in Mar-a-Lago, right, from Zuckerberg to others. And I also think the important thing is Khan's done at the FTC. So I'm not necessarily saying it's going to be an M&A party here, but with her done at the FTC, that changes everything. And I think it just shows that they know ultimately they're going to need to make some deals. Everyone's trying to jockey for position. But when it comes to TikTok, I mean, this would be a golden asset. It would be sold without the algorithm. If it was sold without the algorithm and the hands were forced, 40 to 50 billion would be the price tag. Musk would probably get outside money. You talk about Thiel, where's Larry Ellison involved? Obviously a close friend of Musk, and obviously the relationship with Oracle. There's a lot of areas that this could take.
Dan, though, if TikTok is a national security concern, and we've heard that even from incoming officials that are going to be surrounding President Trump, like Congressman Mike Waltz, like soon-to-be Secretary of State Marco Rubio, then why would they bless a deal that the Chinese Communist Party is basically hand-picking?
Yeah, look, I mean, that's going to be some of the questions. The one thing I would say is, Trump, who obviously was for the ban, against the ban here, if it was under what you say, like an Oracle database and under some sort of, Musk ownership with oversight, it would have to be blessed, obviously within DC and the Beltway. But look, this is tricky. It's all a game of high stakes poker, but it all starts with TikTok. Supreme Court upholds that ban. They're going to look for ways behind the scenes. And I think that's why Trump looks right to the right of him. It's Musk. And this could be a potentially viable option, even if it's a partnership.
Dan, we also see a number of TikTok users already going to some similar social media apps like TikTok. What's in it for Elon Musk to buy it, especially if the algorithm is not included?
Well, for Musk, if he got TikTok, it would be a game changer. The value of X would probably double off the, just off the start. So I think Musk recognizes this is something that would be just a rare, unique opportunity to get not just 170 million in terms of consumers, but what that could ultimately do from a content perspective if their hands forced in terms of ByteDance. And it comes down to, that's why they're going to say what they're going to say publicly. Behind the scenes, I think it's a totally different situation in terms of where this is all playing out.
Dan, can they afford it?
Well, they could afford it when they get outside investments. Musk would not do this solely, and that's why there'll be some consortium that would have to be approved. If we kind of took this step forward, that would have to be approved by DC, by I think those that need to sort of check the box on a deal like this. And that's where when you look at Thiel, Ellison, others within that circle of Musk, clearly could be involved.
Where do you think it would leave Meta?
On the outside looking in, right? Zuckerberg, obviously he's already gone after Jobs. He's gone after Cook, and now you sort of look at Musk as sort of the next step here, right? So Musk and Zuckerberg are at the opposite sides. The problem is that Zuckerberg wants to get in on that inside, but Musk is really the one that has that, unique platform, but also he's the whisperer for Trump. And that's why there's only one person that would be approved by China. It would be Musk, given his strong relationship within Beijing. That's the important thing here. You guys all talked about it. This would be handpicked by Beijing. There's only one individual that they would handpick. It's Musk.
Dan, appreciate your time, sir. As always, enjoy Milan. Atalanta Juventus, I think, is tonight. Reach out to Steve Pagliuca, owns the club. I'm sure he can get you some tickets. Appreciate it, Dan. It's good to see you. Dan Ives, thank you.
Living vicariously through him?
I wanted to do that,
100%.
sure. Yeah, why not?
Yeah.
Why not? It's a few hours away from the city centre.
Yeah, I know. You've already looked into it and bought
Get the car over. Anyway.
He's jealous of you.
It could have been a nice pre-Davos trip.
Can he afford it?
Well, what I find so concerning about this is that how is this going to acquiesce the concerns of individuals in Washington who are concerned about national security when China is saying this is the only guy we're willing to sell it with? that in itself should raise a tremendous amount of questions. And I know their FTC is going to be handing over the reins to Andrew Ferguson. Maybe a deregulatory approach, but not when it comes to big tech. That's not in the cards. And I think Lisa raised a very good point when it comes to antitrust issues.
A big story for us this morning and some fresh Bloomberg reporting on the subject driving things along. Equity futures this morning positive as well by a few tenths of 1% with an update on stories elsewhere. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, good morning, John. NVIDIA CEO Jensen Huang is visiting China this week. It follows the U.S.'s new limits on AI chip sales, which NVIDIA has criticized. China is also currently investigating the company's domestic presence. Huang's visit may involve meeting with Chinese officials, but his plans are unclear and NVIDIA has declined to comment. NVIDIA CEO is expected to arrive around January 15th. Elon Musk will continue to have major access to Donald Trump when he takes office next week. The New York Times reporting that Musk is expected to use the office in the Eisenhower Executive Office building, which is adjacent to the White House. Musk is launching the Department of Government Efficiency, a task force which aims to slash government spending in the Trump administration. It's not clear whether Vivek Ramaswamy, Musk's partner in leading the project, would also have office space in the Eisenhower building. Greenland's prime minister reportedly says that he wants closer ties with the U.S., highlighting the Arctic island's push for independence. President-elect Donald Trump has been repeating his ambition to take control of the self-ruling territory of Denmark, which is home to 57,000 people. House Republicans have introduced a bill to begin negotiations called the Make Greenland Great Again Act. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next, paring back rate cut bets.
The Fed has got to get more strategic in its approach and has got to stop being excessively data dependent. When you're data dependent and you're just looking at the future through the lens of the past, you will get more and more confused as we go through these changes.
That conversation up next, live from New York City. You're watching Bloomberg TV. Equities this morning, and good morning to you. Positive by a third of 1% on the S&P 500. The bond market settling down. Yields a little bit higher, but not even by a basis point. 478.42. Under surveillance this morning, paring back rate cut bets.
The Fed has got to get more strategic in its approach and has got to stop being excessively data dependent. When you're data dependent and you're just looking at the future through the lens of the past, you will get more and more confused as we go through these changes. They've got to either take the approach of this is what we think the baseline is, or alternatively, we're not incorporating any new policies. The muddled middle causes all sorts of spillover effects.
So here's the latest this morning. Investors waiting for PPI out at 8:30 Eastern Time and CPI out tomorrow after recalibrating bets on the Fed's rate cut path. Matt Luzzetti of Deutsche Bank writing, the data supports our view that with growth sturdy, the labour market resilient and inflation sticky, there may be limited scope for the Fed to cut rates this year. Our baseline remains that the Fed will keep rates on hold into 2026. Matt joins us now for more. Matt, good morning. It's good to see you.
Good morning.
This is not a new call.
It is not.
This call a number of months ago, so I want to give you credit for that. What did you see at the time, and how are things playing out now?
Yeah, so we adopted that call back in November. It was after the election, and so I think expected policy changes were part of that. But I think if you looked at the economy in the back half of last year, and certainly what we've seen so far, growth has been strong. We're running growth at 2.5% to 3%, the consumer growing at 3%. We thought that the labor market was showing signs of stabilizing and bouncing back, and I think we certainly got further confirmation of that on Friday. And you had evidence that inflation was sticky. If you look at core PC inflation, it decelerated only very modestly by a tenth or two last year. Super core inflation was actually higher last year than it was the previous year. And so with inflation sticky, growth strong, labor market resilient, and policy changes that could be adding fiscal stimulus, tariff effects, immigration policy that could all be inflationary, we just didn't see scope for the Fed to be cutting rates this year.
Does that mean that you don't think that rates are restrictive where they are?
I think there's not much evidence that they are restrictive enough. So our baseline view is, the nominal neutral rate's around 3.75%. That's well above what the Fed has kind of benchmarked it at, though it's very close to what the market's pricing at the moment. And with that, I think the Fed needs to maintain some level of restriction. And so we have seen the labor market slow. I think that's been a good development from the Fed's perspective in terms of inflation. Governor Waller was really emphasizing that part of it. But when we look at other elements, I mean, consumer spending has not slowed at all. I think we'll get further evidence of that for retail sales this week. So I think it's restrictive. Is it restrictive enough to get inflation all the way down to 2%? That's still an open question.
Which is the reason why you have an increasing number of people not only taking a rate cut off the table, but also talking about the prospect of some sort of rate hike by the end of this year. Do you think that's feasible, or is that a step too far?
It's definitely not part of our baseline at the moment. We still expect that the next move is a rate cut, although we don't expect it until out into 2026. Is it possible? I think absolutely. What would you need to get there? I think you need that the concerns around the labor market fully dissipate for the Fed. So they can't be worried about upside risks to the unemployment rate. Could we get there in a few months with the unemployment rate coming down to 4%, job gains bouncing back? Certainly that looks a lot more plausible after Friday's jobs report. I think you also need to see inflation picking up to 3% or above. So accelerating, not just remaining sticky at these levels. The third thing would be inflation expectations. We have seen recent evidence of that picking up. University of Michigan showed this big uptick last Friday. The New York Fed's gauge actually picked up a little bit yesterday. So it's something to keep a watch on. But for the Fed, they first, I think, would use forward guidance, take out the rate cuts that they have in their dot plot, see what that did for financial conditions. We are seeing higher rates now tightening financial conditions a little bit. So the first thing for the Fed would be to guide towards rate being on hold before they contemplate rate hikes.
In your note about Trump 2.0, you talk about growth too fast, inflation too furious. What part of Trump's policies do you think are going to be the most inflationary, given the fact that the sausage making we're all witnessing in real time, and it's whipsawing based off report after another report?
Yeah, no, absolutely. I think it's important in thinking about the outlook. One is, what do we know about the economy prior to the policies? And there, it's kind of everything that I just outlined. Growth was stronger, labor market resilient to inflation, stickier. There's still lots of uncertainty about what tariff policies. We got some news or information overnight that it could be a more gradualist approach. When we think about our forecast, we did bake in tariffs. We have a 20 percentage point increase in tariffs on China. We have some increase in tariffs on European auto imports this year. And then we have a universal baseline tariff at a small amount next year. That is the most inflationary part of our forecast, but it only adds about 0.2 to inflation. Is there scope for that to be more, depending on if they come in more aggressively? I think absolutely.
What about Trump's immigration policies?
Absolutely has a chance to be inflationary as well. We do not have anything baked into our forecasts. From an immigration perspective, we essentially have immigration flows returning to where they were from a pre-COVID perspective. But when you look back at 2023, the biggest shock or surprise to the economy was this big influx of immigration flows and what that did to the labor force. We think that subtracted 25 to 50 basis points from core PCE inflation. So it was a meaningful disinflationary force. It was an important factor that brought the labor market into better balance without the unemployment rate moving higher. If you unwind that, it would be inflationary.
Do you think that supply side story distorted the Fed's view of how tight they actually were?
I think absolutely. I mean, we weren't building it in. We were not anticipating it. So we were not expecting that you'd see growth closer to 3%, but that happening importantly with disinflation in the background. That came as a big surprise, was the biggest surprise for the economy in 2023 and then into 2024.
That discussion is politically charged, Lisa, for obvious reasons, but ultimately it bailed out the Federal Reserve in a big way. In a big way.
And maybe it was one reason why, especially because some of that was undercounted, why the Federal Reserve underestimated the power. Maybe that the blip that we saw, the weakness late last year in the labor market, maybe was the anomaly, not necessarily the beginning of a new trend.
Just quickly, I've got 20 seconds on the clock. Are you mentally adjusting that payrolls figure from Friday lower? Do you think that was the real deal?
So I think that there's definitely some seasonality on some of these things. Retail trade was very weak in November, stronger in December. I don't think that we're running at 250,000 jobs on month on average. But the key question for markets and the Fed is, are labor market trends strong enough that they're stable to potentially tightening a little bit here? And I think the answer is yes. Not that we're printing 250,000, but that we don't have to be as worried about the downside risks.
Matt, appreciate your time. Always good to see you. Matt Luzzetti of Deutsche Bank. That call made back in November is looking better and better. Data point to data point. We get another data point a little bit later this morning. PPI at 8:30 Eastern Time. At a second hour of Bloomberg Surveillance, your lineup looks like this. Emily Roland of John Hancock. Libby Cantrill of Pimco. We'll catch up with the Rheinmetall CEO, Armin, Papperger, and the Villa Home CEO, Sean Roberts. From New York, this is Bloomberg.
high-frequency data matters a lot, and it will be noisy in the coming months.
It just looks like a very precarious stability, and we see that in survey data, anecdotes in the Fed's beige book, and so I don't really see that picture changing.
One way or the other, the Fed will get this under control. It just may take a little bit of tightening in between.
The rates market, the tightening of financial conditions is feeding back into equities, and it's causing risk off.
If the economy's strong, shouldn't that be good for earnings? And if so, maybe earnings start to help stabilize things.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now with equity futures looking better than they have looked over the past few days, up 1/3% on the S&P 500, on the Nasdaq 100, up around about 0.5%. The gains are bigger in Europe. They were bigger in China overnight. The Euro Stoxx 50 right now up by 1 full percentage point as we take out a little bit of heat from this dollar rally. Euro dollar positive on the session. We're up to about 102.54. The headline from the team here at Bloomberg: according to people familiar with the matter, key members of President-elect Donald Trump's incoming team discussing slowly ramping up tariffs, a gradual approach month by month.
Which, again, just points to how much, uncertainty there is about policy going forward, that this headline that hasn't necessarily been solidified, that is still a proposal, although from key advisors to President-elect Donald Trump, would have such a big impact on markets. But also, there's a larger question here, which is, again, what is the bigger risk? Is it downside risk to growth, or is it upside risk to growth? And is that what we're really seeing play into the bond market?
I think one key part of this report, though, is that it has not been presented yet to President-elect Donald Trump. It's just from one faction of his economic team. And it's those that we already knew their views well ahead of the election. Someone like Scott Bessent, who joined this program and talked about a gradual approach. Talked about when Trump talks about 60% tariffs on China or 10% tariff war around the United States, it's a maximalist approach for negotiating tactic. So this could be one way they go. But what we are seeing right now, and let's remember, he is a president-elect at the moment. What we are seeing right now is the sausage making in real time.
There is one key consistent theme, though, in all of this, the conversation Lisa's having and Anne-Marie's having: inflation risk. You go through the body of the story and the reporting from the team here at Bloomberg, the objective here of taking a gradual approach is to avoid an inflationary spike. That's what this is about. The worry on Friday when you see a big payrolls report is about a re-acceleration in inflation. It's not about a re-acceleration in growth. It's about a re-acceleration in inflation alongside that and where it leaves this Federal Reserve.
And it highlights the difference between 2016, the last time Donald Trump was elected, and now. And basically the idea that inflation is at a much higher place just structurally than it was back then, at a time where there still is strength in the economy, which is going to tie the hands of a president who is a real estate owner. He wants rates lower. And yet, will that be possible given the inflationary dynamics?
And raises questions about how constrained this administration will be by the bond market. We mentioned it a little bit earlier in the last hour or so. To hear the Vice President-elect, J.D. Vance, on American Broadcast News over the weekend, bringing up the bond market, not once, not twice, repeatedly, and doing so without even being prompted. That's where the focus is as they come into power.
Well, that's what I thought was so interesting about it. He wasn't prompted on the bond market at all. This was Shannon Bream on Fox News Sunday. She wasn't asking about the nuance of the bond market. He was talking about how bond yields are just too high. And then he talked about the fact that the net interest payments were more than our national defense, and they're on track to be that as well in 2025. And then Speaker McCarthy said to me, well, the market will decide. Well, if that's the case, then this reconciliation package, these tariffs, they need to make sure they have a handle on how much spending this is going to be.
How long before we coin MBAGA? Make bond auctions great again.
Wow, okay.
I think it's going to be a while for that one.
I'm going to stick my neck out and just say that's not going to catch on. All right?
MBAGA.
I don't think
I just think that could be really important because I think that's part of what's going on here.
All right, Bramo. Next off for this market. Going to take some time to recover from that.
Please go ahead.
PPI at 8:30 Eastern Time, CPI tomorrow, and lots of bank earnings tomorrow too. JP Morgan, Citi, Wells Fargo, and Goldman Sachs. Coming up this hour, less of that, more of this. Emily Roland of John Hancock as stocks look to build on yesterday's gains. Libby Cantrill of Pimco as Trump's team considers a gradual approach to tariffs. And Sean Roberts of Villa Homes on the path to rebuild Los Angeles. We begin this hour with stocks pushing higher. Investors optimistic on a Bloomberg report that Donald Trump's economic team is considering a gradual approach on tariffs. Joining us now, Emily Roland of John Hancock. Emily, good morning.
Morning.
We have been whipsawed from headline to headline, from data point to data point. Is this one any different?
I mean, it's just remarkable. And one of the things that we've been watching closely is the moves in the U.S. dollar. One of the things that we think has started to constrain equity markets so far this year is you've seen this significant strengthening in the U.S. dollar. You think about large cap equities, which were just carrying the crown of leadership last year. 40% of their revenues are derived from abroad. So that could be a significant issue for large cap stocks this year. So I think this morning you're seeing a bit of a modest pullback in the dollar, and that's probably helping risk assets a little bit.
Mike Wilson, Morgan Stanley, said rates drive beta, and what you're seeing in foreign exchange drives dispersion. Are you starting to see that beneath the surface on the S&P?
We're seeing a little bit of a broadening out in market leadership. Leadership is a tough word, I guess, right now, where we're seeing some pressure on markets. But what we typically see in these environments where bond yields are backing up, inflationary pressures or potential inflationary pressures, to your point, are building is things like value stocks start to do a bit better. Small caps get hurt. Of course, they have the highest levels of indebtedness, which can be an issue when the cost of capital is elevated. But I think value equities, in particular areas like energy, utilities, infrastructure-related assets, those are lower beta. They're more defensive businesses. They have dividends, and they have some element of inflation protection here that we think might be accretive to investors into this year if we see maybe another 2022 type playbook.
This is a confusing moment. This is confusing for all of us. It's hard to really understand where the lodestar is at a time where there's so many different narratives that go completely contrary to each other. I want to go back to 6 a.m. this morning when we got NFIB small business optimism, which came in at the highest rate going back to 2018 at 105, really superseding expectations. Do you want to be more levered to a growth story or more levered to a conservative portfolio, one that is more protective and levered to maybe downside risk right now?
We would say a more conservative portfolio right now. What we're seeing right now is the biggest catch up in history between soft data and hard data. So the hard data had been coming in well, things like the labor market. Of course, we added 250,000 new jobs last month. But when we look at the soft data, it had really been struggling, and then boom. You get the results of the election and you have this massive amount of optimism and sentiment just pervading the markets. So we want to be mindful of watching this kind of mini bump in reacceleration and animal spirits and sort of in the way that business owners and people are feeling in general. Of course, there's a huge divergence between Republicans that are responding to those surveys and Democrats that are responding to those surveys. So we want to be mindful of that. We may be seeing a modest reacceleration in the economy, but the challenge is, and you guys have talked a lot about this on the show, is kind of the self-limiting dynamic of this backup in treasury yields that we're seeing on this potential reacceleration in growth. Borrowing costs are high. Mortgage rates are above 7%. Mortgage applications are plunging. Inventories are up. Housing is the economic cycle. And if we start to see the shelter component of CPI decelerating, that could speak volumes to the cross-asset dynamics.
But this story has been one that's consistent over the past couple of years, that it's been a frozen housing market. And that's only led to higher prices because everything else is doing okay. And there hasn't been enough supply. How much conviction do you have in this call of a slowdown to go headlong into longer-term treasuries at a time where other people are saying, you might want to wait a little bit?
Well, it's not headlong. So we still haven't been overweight duration. We've just suggested that investors that are sitting at the short end of the curve leg into the intermediate part of the curve with a benchmark level of duration. And right now, the way the yield curve is sloped, we now have the potential for roll down as well, with the short end of the curve actually being significantly lower than the long end of the curve. I think what's notable about the housing market is you're seeing inventories up about 30% year over year. And a lot of that's concentrated in the hot spots. Like, remember when everybody left Manhattan during the pandemic or the West Coast and they went to Austin and they went to Nashville? By the way, great cities. They went to Colorado. But what's happening now is Manhattan-based companies are saying, you have a job in New York. Guess where you have to go? New York. So you're starting to see all that built-up inventory come back online in some of those areas as people migrate back to the major cities.
Emily, do you have a call on how high you think we could see the 10 years? People are debating whether or not we actually will hit and can sustain 5%.
Yeah, so 5% I think is about the area where you kind of see that self-limiting mechanism creep in. We're watching bond yields, of course, overseas, which you're going to see sort of an element of tracking there. And if all these overseas markets also have a harder time adjusting higher rates, you could see some downward pressure on Treasury yields from there. But let's just do we want to do a little bond math? I know it's really early in the morning.
Go for
Lisa,
it.
but even so think about, say yields went back up to 5.5%. You're still not seeing a negative return on the aggregate bond index because the yield is there. We're looking at yields that are above 5% on high quality bonds right now. You might have to get paid to wait on the duration front if yields sort of chop around from here. But think about what equity markets might do in an environment where we're at a 5.5% Treasury yield. I don't think they would like it. So I think the fact that you're flat on bonds, you might want to take that.
I'm not sure what Lisa started, but Kevin Gordon of Schwab has written in and said it's Barbara. Bonds are really back and really awesome.
I love it.
I'm not sure that's catching on either.
More of this.
I got another message as well on the Bloomberg terminal. Turn her Bloomberg off and tell her to start her vacation now. When does this vacation begin?
Hey,
a few hours time.
You really want me to go on vacation? I'll happily leave. Thank you so much. It's been really real.
Emily, appreciate your time. It's
Thank
good
you.
to see you. Thank you for being here. Emily Roland there of John Hancock. Equity futures this morning slightly positive with an update on stories elsewhere. Let's get to your Bloomberg brief and cross over to Danny Berger. Hey, Danny.
Hey, John. Los Angeles and the rest of Southern California are facing a second week of fierce winds as two major fires continue to burn across the city. Crews have been struggling to contain the fires, which have killed at least 24 people and scorched nearly 40,000 acres. The disaster is expected to be among the most costly in U.S. history, with estimated damages and losses between $250 billion and $275 billion. Special counsel Jack Smith said in a report that the Justice Department and that the president-elect could have been convicted for trying to overturn the 2020 presidential election. Smith's report details Trump's efforts to pressure Vice President Mike Pence to reject congressional certification of the election. It also highlights Trump's refusal to help stop the Jan 6 riot at the Capitol. Cleveland Cliffs and Nucor are looking at a joint offer for U.S. Steel. People familiar say the Cliffs CEO confirmed his interest in a media event and later told Bloomberg that he'd fund a deal using debt. A source says the partnership could include Cliffs acquiring most of U.S. Steel, while Nucor takes its mini mill assets. Shares of Cleveland Cliffs rising just by 0.5% on the news. And that's your brief. John.
Danny, appreciate it. More from Danny in about 30 minutes' time. Up next on the program, setting Donald Trump's tariffs in motion.
I think everyone is on board with a kind of forward guidance or a phased-in tariffs. If you bring down your tariffs, we will bring down ours.
That was back in August. We'll get to the latest up next from New York. This is Bloomberg. Equity futures right now up by 0.2% on the S&P. Bond yields a little bit higher. Your 10-year 479.24. Under surveillance this morning, setting Donald Trump's tariffs in motion.
I have spoken to the president, spoken to his team, and I think everyone is on board with a kind of forward guidance or a phased-in tariffs. So, here's President Xi, here's 60%. It might be 2.5% a month for 24 months. Tell us when you've had enough. And at the end of the day, I think that Donald Trump views tariffs as a way not to, as an end to free trade. If you bring down your tariffs, we will bring down ours.
So that was back in August. Sound familiar? Here's the latest reporting. Bloomberg reporting President-elect Donald Trump's incoming economic team is considering a measured approach for implementing tariffs, gradually increasing the duties by fewer than 5% per month to ramp up negotiating pressure and sidestep inflationary impacts. With the latest, here's Tyler Kendall with more. Tyler, good morning to you. Is Scott Bessent at the epicenter of this effort?
Yeah, good morning, John. Clearly, he's going to face those questions as we look ahead to his confirmation hearing on Thursday. But it is worth to mention again that those potential reasoning behind a gradual tariff approach could be twofold. One, to tamp down on concerns about any potential inflationary impacts, and two, to serve as negotiating leverage. I can tell you here in Washington, we actually had the Canadian ambassador to the U.S., Kirsten Hillman, on balance of power last night who said that they are actively looking for ways to get to that negotiating table and that nothing would be off the table, except, of course, an acquisition of Canada. But clearly a bid to try to de-escalate tensions before they get here. And on the second point about any potential inflationary impacts, I actually caught up with one Republican strategist who told me, look, this is going to be way more palatable for congressional Republicans in particular, who will be questioning Scott Bessent later this week, who have already expressed concerns about tariffs and in particular about rhetoric about any spike in prices and what that could mean to Republicans as they try to hold on to their slim majority in Congress going through for the next 2 years. And then again in the 2026 midterms, since they would like to see unified government for the total of 4 years under Trump's term. Just lastly, John, Bloomberg News, of course, reporting that President-elect Trump has not yet been presented with these plans. They're still very preliminary, but that they likely would be enacted under some sort of emergency power. We know that Scott Bessent would be needed for that.
Tyler Kendall, appreciate it. Tyler, down in Washington, D.C. Initially, these headlines were moving markets around, some dollar weakness. I can tell you just moments ago, euro dollar turning negative briefly on the session, now totally unchanged at 102.45. Libby Cantrill of Pimco is joining us around the table for more. Libby, good morning.
Good morning.
Good to see you. Let's talk about base case assumptions, underlying assumptions for you and the team at the moment. What are they? We've had reports from the Washington Post, from CNN, from us overnight. They're all considerations. The president hasn't signed off. What do you think will be when we end up?
I think in general, just in terms of the economic policy writ large, there are more questions than answers at this point. I think our view and what we're signaling to clients is that don't underestimate President Trump in terms of how deep-seated this ideology is. He's been talking about tariffs since the 1980s. He really is very focused on the goods trade deficit, which has increased with most countries, except for China, which it has declined, although China, of course, we continue to have the highest goods trade deficit with. So don't underestimate this. But I mean, he obviously, inflation was a huge issue for voters. And so he is going to be, it sounds like, potentially mindful, or his advisors, I should say. I think this is very interesting. This plan hasn't been presented to the president. And he is the ultimate economic advisor. He is his own economic advisor. So I think we should take all of these reports also with a grain of salt. But again, what we're telling our clients is let's not underestimate the deep-seated ideology that underpins some of these threats. And while, we sort of say, while transaction man is going to be there, tariff man will also be very much present. And, if there is forward guidance, if they do try to feather it in, maybe it doesn't spook markets, but we are preparing for increased tariffs, by and large.
He does like tariffs. I mean, over the course of the campaign, he called it the most beautiful word in the dictionary. At the same time, he also likes deals. Do you see tariffs as a means to an end, or you think he actually wants to do them to revenue raise?
Well, this is where I think that there's part of it where it is a means to an end, absolutely. And he and his trade advisors point out the fact that other countries do have elevated tariffs on the United States. And so there should be some reciprocity, whether they decrease their tariffs or we increase ours. So I do think that for many of these countries, a deal could potentially be on the table. But again, this is where my own view is just don't underestimate how how deep-seated, how firmly he believes this philosophy that tariffs are actually not necessarily a problem, but they can be a solution. They can be a solution in terms of getting countries to the negotiating table, but I think more aptly, given where the deficits are, they can be a big revenue raiser.
A source reminded me recently of Trump 1.0 at the G7 in Canada, when before he left to go to that meeting in North Korea, with the North Korean leader, he said to them, I'll lift my tariffs if you lift yours. If you have free trade, I'm willing to have free trade. Who's willing, do you think, to be the first at the negotiating table with him?
Yeah, I think that's a good question. And I also think, what does he accept? I mean, there are, I don't think you can talk about all these countries as a monolith. Obviously, some countries have, different tariff rates. China in particular, I think there's maybe less of a scope for a deal, just given the experience that President Trump had and Trump 1.0, but also his advisors had. I mean, a lot of the folks who are going to be advising him were also at the table. Jamieson Greer in particular, who's the nominee for the USTR, he was at the table in the phase one, and I do think there is a view that China never really honored their promises. So maybe less of a scope for a deal with China, but the EU, for instance, I think is going to be a big focus. We know that President Trump also has an issue with EU autos in particular, and that may be an area where there is some scope for a deal. So it's hard to say, but I also think there's a real question on President Trump's side is how open is he to a deal? And I think maybe with China, less open just given what happened under Trump.
It's a good point on autos. Angela Merkel would say that Trump used to always say to her, why don't I see any Fords here? While I'm in New York City, I see Mercedes all over the place. You have these 5 Ds of Trump 2.0, deglobalization, deficit finance, tax cuts, DOGE, deregulation, deportation. Which out of these is getting your clients the most concerned?
Well, I think it depends on actually where they're located. A lot of our clients, I think, overseas are very focused on some of the risks to the economic forecast, particularly as it relates to tariffs, potentially the detrimental impacts of immigration on growth. I think some of our domestic clients more do see this as a mixed bag. And again, I think the open question about our 5D framework is really the sequencing of course, the scope of those policies, but also the sequencing. Do they lead with draconian tariffs and big actions on immigration, or is that more of a phasing in and you get some of the tailwinds from the increased tax cuts and deregulation and what have you? So again, many more questions, I should say, than answers at this point. But a lot of this will depend on scope and sequencing.
Just going back to the 5 Ds, and Happy New Year, welcome back, Libby. But I do look at these, and I do think that
statute of limitation. But
this idea of
why do I feel like that was to troll me?
No, not at all. Well,
you and Larry David, you're not bad company.
Let's move on. So deficit finance tax cuts. I think you still can say Happy New Year. It's the new year. I haven't seen Libby. I'm always happy to see Libby. Deficit finance tax cuts and DOGE. Do they offset one another? Or is the deficit financing really the main piece that everyone keeps honing in on?
Yeah, I think this is something obviously that the market is trying to digest right now. Is that, how much of this will actually be paid for? And look, I think the DOGE effort is real, right? This is to Elon Musk and Vivek Ramaswamy's credit. They really are trying to kind of penetrate some of even the nomination process in terms of inculcating them with this sort of DOGE ethos of increasing efficiencies and potentially cutting spending. I do think there is a natural limit to what they can get done, though, and this is just a question of how slim these majorities are in Congress. The House majority on the Republican side, and I've said this to you all again and again, but I do think this is worth repeating, is that for several months this year, it's going to be a 0-vote majority because you're going to have 3 vacancies on the Republican side. And that means that Republicans can lose no votes and still pass things. Now, even when they're fully staffed, fully seated, they're only going to be able to lose 2 votes. And so this is where it really is a question of it's easier to eat dessert than vegetables. It's easier to cut taxes than it is to actually cut spending, because when you're cutting spending, you are actually practically impacting constituents in these House districts. So I do think, kind of a long way of saying, my view probably will be, some of it will be paid for, but it will be an impact on the deficit.
How many representatives look at the 10-year bond yield before they go in for negotiations?
I don't think very many, with all due respect to the members of Congress. Unless they're on the committee of jurisdiction, these folks are, they're small business people, they're farmers, they're state legislators. These are so smart people and sophisticated in their own right, but they're not necessarily market participants. And so, is the 10-year capturing the attention of folks who are on those committees of jurisdiction? Probably, but outside of that, I'm not sure what the reaction function from between the market and between Washington is. I think much more so is when they hear from their constituents that mortgage rates are higher, that they can't get a loan, that they can't get out of their house. I think that is much more kind of apt to actually influence members than what the 10-year is.
It's hard to tell constituents that rates are lower at the Federal Reserve, but mortgage rates are higher. Mm-hmm. It's hard to explain that.
It's hard to explain all of this, and it's harder to explain that I'm going to cut your benefits and I'm going to cut costs here by not putting as many lights in or utilities that are going to get upgraded because your mortgage rates are high. How do you explain that to people?
Bond yield to higher again this morning, up by a single basis point, and that post bump off the back of our story, that post-story bump, has faded. Equity futures right now positive by only 0.2%. Libby, it's good to see you.
Good to see you. Happy New Year.
Happy New Year. Libby Cantrill at Pimco, forcing it out of me. Up next on the programme, Armin Papperger of Rheinmetall on the outlook for Ukraine as President-elect Donald Trump takes office. An important conversation just around the corner. As I say, the bump in futures fading just a little bit. Likewise, the story of the US dollar. That was a whole lot weaker earlier on in the session. Euro dollar just about unchanged at 102.50.
The bump in equity futures fading just a touch, still positive, but up by 0.25% on the S&P 500. On the Nasdaq 100, we're higher by, let's call it 1/3%. With some morning movers this morning, let's cross over to Manus Cranny. Good morning, Manus.
Jonathan, good morning. We know Elon Musk is taking a great deal of the oxygen out of the technology realm between the possibility of a TikTok deal, but back to basics, which is Tesla, the stock up at 1.5% this morning. Morgan Stanley, a lot being written out there. They are justifying the bull case. The bull case in an extreme scenario could be $800 for them. They say the advancements in autonomous vehicles, that's what the market is really beginning to appreciate. The leadership that they have, not just in the vehicles, but in the AI, the data collection. Data collection, TikTok, X, Tesla, there's a narrative there. It's about data collection and power of what you do with that. Robotics, along with energy storage. So it's about a reappreciation of what actually is in there in terms of the size and the scale of mobility, 7.5 million vehicles in 10 years' time. If you want to understand the boom in the housing market, mortgage rates might be at 7%. It's hard to lock in a deal. Look at this, KB Homes. This is a representation of the bull case for housing despite mortgage rates being at 7%. Revenue $2 billion, new orders up 41%. Buyers continue to demonstrate a desire for home ownership and the housing market conditions. So despite the rates price, it's in our blood that we want to be home ownership. We want to be involved in home ownership. I round it off with a deal. Again, the deal, it's not so much the size of the company of H&E. Look at this, up 107%. You've got United Rentals going after this company. They're prepared to pay $3.4 billion in cash. It's the story. It's like a home builder story. This is about renting for industrial and construction business in the United States of America. This is a trade on growth. This is a trade on U.S. growth, exceptionalism and divergence. That's what you walk away from in terms of the housing report, in terms of this particular deal. There's a number of narratives to tie together. Jonathan.
Manus, thank you. Solid numbers coming from KB Home. Really impressive. Big move from that stock this morning. Out of surveillance this morning, Donald Trump and Joe Biden both optimistic that a ceasefire deal between Israel and Hamas could be coming within days. Trump saying, quote, maybe by the end of the week. Biden saying both sides are on the brink of a proposal. To go to our next story, Cleveland Cliffs and Nucor are weighing a potential joint bid for US Steel. Sources telling us here at Bloomberg that deal would involve Cleveland Cliffs acquiring most of the firm, while Nucor taking its so-called mini mill assets. Lisa, another entrant into this saga.
Did you see what the commentary was from the Cleveland Cliffs CEO, where he said that basically Japan was evil and explained that his plan was to be an all-American one? And then you had, of course, Nippon Steel come back and say, look, we're going to keep it together and invest a lot more. So, watch the space.
Yeah, this drama's not over. How many times have we said that over the past few months?
And we'll keep doing it.
This drama's not over. NVIDIA CEO Jensen Huang is slated to arrive in China tomorrow as employees celebrate Lunar New Year. His visit coming at a tense time as both US and Chinese officials scrutinize the chip giant. The White House unveiling new curbs on NVIDIA exports, and Beijing investigating antitrust allegations.
Really interesting time because, of course, Beijing is looking into NVIDIA and they have a probe on the company. But when you talk about what the White House just did in terms of that tier approach on AI chips, NVIDIA blasted the Biden administration. He's going to China now to probably talk about some of these new curbs and that probe. What's interesting is he's going to China at the same time we get Trump coming in. And a lot of these executives, I'm sure, were invited to attend that administration, but he's going to go do some external diplomacy.
That stock is up this morning. It comes at a time, Lisa, and you talked about this earlier, where some weakness has started to creep into that name and some other big ones too.
That name is down almost 11% in the past 7 days. That is pretty shocking. And you're looking at a time when there's some questions around delays to certain chips, and then some companies actually ratcheting back some of their orders from NVIDIA, and they are caught hamstrung between the trade, the tit for tat between the U.S. and China. So, yeah, this is going to be an interesting name since it's led a lot of the growth in the S&P.
Three of the stories on our radar this morning. NVIDIA higher by 1% in the pre-market. Let's turn to the Russia-Ukraine war. President-elect Donald Trump continuing his push to increase defense spending. The German Chancellor Olaf Scholz rejecting Trump's demands that NATO allies increase defense spending to 5% from 2% of GDP. Joining us now, Armin Papperger, CEO of Rheinmetall, a German defense and engineering group. Armin, good morning. It's good to see you in New York.
Good morning.
Got to start with a very serious topic, and from there the topics get even more serious. But let's start with you first of all, sir, personally. According to multiple US and Western officials, the Russian government planned to assassinate you. This has been in the news over a number of months now. Can we start with that and talk to you about how things are going personally? When were you told about that, and by who?
It's about 1 year ago.
and the information we've got from the US, from FBI. And I'm very happy about that, that they very early gave us that information. German government took that information, and the protection level now is very high. I have the same protection level than the Chancellor.
Wow, you have the same security protections as the Chancellor, Olaf Scholz. Yeah. And do you feel secure?
I feel secure.
Is there a reason why you wanted to stay in the job, even though that threat was hanging over you?
I love that job. We have to work. We have to work for freedom, and we have to work for democracy, and nobody can stop us,
including Russia. Let's talk about the challenge that comes from Russia now, and the push from the incoming president to push defence spending, perhaps as high as 5% as GDP, and we know that's been a struggle for many NATO members to get to 2% over the last number of years. Do you think that's doable, to get to 5% of GDP?
I think 5%, it's a big value, 5%. And I believe that if we first of all get to 3%, it would be great, because over the last 25 years, the Europeans did not invest enough money in security. I understand 100% President Trump. He's right, that Europe has to spend more into the Western security, and we have to do it.
Well, my reporting over the summer was actually they were looking at 3%. So potentially this falls down to anywhere from 3 to 5. Germany, though, is only spending 2%. Do you think they can spend more on defense?
I think they can, and I think they have to do, because at the end of the day, Germany is the biggest economic in Europe, and they have to help to make Europe safe.
We just heard from Mark Rutte last month talking about it's time for Europe to shift to a wartime mindset. For decades, Europe decided to curb their defense spending and really outsource their defense to the United States. That failed, obviously, when Russia invaded Ukraine. Do you think Europe is still unprepared for the war that's on their doorstep?
We prepare ourselves. And if you see what we do in Rheinmetall is we invested over the last 2 years more than 7 billion to build up the capacities. And that's very important. And in between, I am able to produce 1.1 million artillery rounds, which is more than the US is doing at the moment. So I think we prepare ourselves, but we have to do more.
You also have production facilities inside Ukraine.
Yes.
How quickly will we be able to get ammunition production going inside the country?
In 12 months' time.
In 12 months' time?
Yes, yes.
There is potential that in 12 months' time, according to President-elect, this war could be over. Do you foresee a scenario where Putin will agree to some sort of ceasefire in Ukraine?
Nobody knows that, and as you know, President Trump said he's able to do it very fast. We will see if that really will happen. But even if that will happen, we need a lot more defense goods, because at the moment, as you know, the stocks are empty, especially for ammunition. But although the tanks, we have not enough tanks, we cannot protect ourselves.
What about the incoming administration in terms of communication? You are really the massive player in Europe, almost the only game in town when it comes to the European defense industrial complex. Are you talking to the incoming Trump administration?
We start to talk to that, and I will talk very, very early with the Trump administration, because we have to do it. And the reason is that I also have a lot of investments here in the US. And I invested some months ago more than $1 billion also to buy a company here, because I believe in the transatlantic relationship.
Do you think that you can partner with this incoming administration? And how was the communication and partnership with the Biden administration?
It was good, but at the end of the day, we as a company, we must be politically, let me say, a little bit independent. And we have to work with all governments. And that's very important. And I believe that we really can work with the Trump administration, because I believe that he is right. And the pressure that he is creating at the moment is good for Europe.
He's right with respect to spending more on defense. But is he right about the U.S. retracting some of its spending on Ukraine and really leaving it to the European Union to finance the efforts there?
I believe that we have to help Ukraine. If Ukraine will fall, we will have a big problem in Europe. If we have a big problem in Europe, because I believe that Putin will not stop with the on the Ukrainian border. So what about the Baltics? What about Georgia? What about Moldavia and all the other things? And I believe that it will be very, very helpful if the US and Europe is working together in this area. And at the moment, Europe needs US because the resources are not good enough in Europe.
Do you think there is a political will in Europe to offset any decrease in financing from the United States at a time of political turmoil where there's even upset in leadership in Germany and real questions around how much the public wants to keep financing this?
I believe that the new government in Germany, and as you know, we have election in 7-8 weeks, that the new government will create a very strong contact to the Trump administration. And I believe that they want to work out a good plan and to make a deal together. Europe and the US has to make a deal for security.
You talked about how you're investing in the United States, and I'm wondering how important it is to get a foothold in the U.S. to get around any potential tariffs or other types of issues that come down the pike.
Very important, very important. I understand all the issues that the U.S. has, and I said, okay, we want to make money, and President Trump wants to make deals, and he's right about that, and we have to take care about that. That's the reason that we are investing also in the U.S.
Are you also ratcheting back certain businesses in Europe that you think are going to be more exposed?
We grow at the moment 40% per year, so we can grow in Europe, and we have to grow in the U.S.
The president wants to make deals. Do you want to make deals? Do you think we need some consolidation in European defence?
Yes, I think it's possible, and I think it's important to do it. As I always said, Europe needs also a bigger machine in defence. And what I believe is we need a company which makes 40 billion per year. We are at the moment only on the level of 10 billion, but we will grow over the next years to 20 billion, maybe more. And the backlog is a very good one, so I believe that consolidation is very important.
You can grow organically to 20.
Yes.
Acquisitions, have you got any in mind?
Yes, we have a lot in mind because, as you said, over the last 2 years we bought the lock performance here in the U.S. and the Spanish company.
Yeah.
We invested 2.2 billion in that, and we want to invest more, and we have more firepower.
Have you spoken to BAE?
We always speak with BAE, but
You've spoken to them about a possible acquisition?
No, we didn't speak about to merge or other things.
Would you be open to that?
At the moment, there is no discussion.
But would you be open to it? Would it make sense?
I'm always open if it makes sense.
And does it make sense?
I'm not sure, but we have to analyze that.
I want to go back to how John really started this topic. The fact that your life was put at risk. You're basically on a Russian hit list, but it goes beyond that. Dmitry Peskov last year said your company is, quote, a legitimate target. How, as a company, are you responding to Russia's hybrid warfare on the continent?
First of all, we have a very, very good cyber center. That's the most important thing, that cyber attacks will not come in. And the second point is we are not in war at the moment. I have not air defense and missiles around my factories. But if there is a higher potential that something will grow up, then we will have to do that, for sure. We will protect our factories, and we have to do it.
Right. And you feel like the German government is a partner with you in this?
Absolutely. Absolutely. We are absolutely fighting shoulder on shoulder.
And when it comes to this assassination attempt on your life, do you believe it came from Vladimir Putin himself?
I don't know. And at the end of the day, the information, as I told you, came from secret services, and we have to take care about that. And the government in Germany takes care about it. Not only the German government, also governments, if I travel to other countries, also that governments take care about that. I'm very grateful about that.
You've been very gracious with your time, sir, and we appreciate it this morning. Thank you very much.
Thank you.
Thank you. Armin Papperger there, the Rheinmetall CEO. That stock has been on absolute fire over the last several years, that's for sure. And particularly after, again, we got another bump in early November following the election of President Donald Trump. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. A new wildfire broke out last night in California's Ventura County and rapidly grew to cover more than 50 acres. The fire started shortly after the National Weather Service warns that portions of Los Angeles and Ventura counties will face a particularly dangerous situation this week. At least 24 people have been killed and 12,000 buildings have been destroyed. The SEC has fined a number of Wall Street's top investment firms for failing to track their employees' business communications. Firms including Blackstone, KKR, Apollo, and Charles Schwab will have to pay over $63 million for not monitoring and archiving employee text messages for business purposes. Investment advisor broker-dealers admitted to the violations and vowed to improve compliance. The settlements are part of the SEC's ongoing crackdown on the use of unauthorized messaging apps. Two Chinese social media apps, Xiaohongshu and Lemon 8, have taken over the top two positions on Apple's iPhone download charts in the U.S. The rise of these popular Chinese apps is seen as a response to the impending ban on TikTok in the U.S. Many users seeking out alternative social media platforms. A string of new English language content and users showed up on Xiaohongshu this week. The hashtag TikTok refugee has garnered more than 44 million views. And that's your brief. John.
Danny, thank you. Appreciate it. Up next on the program, the cost of rebuilding in California.
Get the permit and do it in a way that we've done it with the experience at hand in other communities that have been similarly ravaged by wildfires. The scale of this is going to require us to be better and do better.
That conversation up next. Live from New York, you're watching Bloomberg TV. Equities just about hanging in there, positive by 0.33% on the S&P 500. Bond yields just bleeding a little bit higher, up a single basis point. The 10-year 478.83 in about 41 minutes' time. PPI data in America, the appetizer for the big one tomorrow. The main course, CPI, tomorrow morning at 8:30 Eastern Time. Under surveillance this morning, the cost of rebuilding in California.
Time value to construction. Get the permits. State, deal with all of those, create a specific timeline, making it up. We're working on the exact date, so don't hold me to it. 120 days. Get the permit and do it in a way that we've done it with the experience at hand in other communities that have been similarly ravaged by wildfires. We know how to do this. We've done it in the past. We learn, we iterate, but the scale of this is going to require us to be better and do better.
So here's the latest this morning. Southern California facing another round of dangerous fire weather. At least 24 people are dead. 12,000 buildings have been destroyed in fires that have been burning for more than a week. Wells Fargo, Goldman Sachs, both estimating insured losses could be as much as $30 billion. Villa Home CEO Sean Roberts writing, construction activity through the rebuild will drive construction costs up throughout Southern California in an already labour-constrained and expensive market for building. Sean joins us now for more. Sean, thanks for giving us some time this morning. We appreciate it, sir. Can you just walk us through and just build on what you've already said, how difficult this rebuild effort will be?
For sure. Well, first and foremost, my heart goes out to everyone that's been impacted. And thank you to all the firefighters and first responders that have been handling this. We're going to see a lot of changes in the Los Angeles real estate market. Like, rents are already going up, home prices are likely to increase, insurance costs are going to go up. And as it relates to the rebuild, this is a tremendous amount of construction activity that's going to be happening in the market over the coming months and years in an already very expensive and trade-constrained market where it's hard to build. And a lot of the things that Governor Newsom was talking about in the clip that you rolled are really important. One of the things that's concerning us quite a bit is the pace of permitting. And we're glad to see the authorities getting ahead of that now, but the devil's going to be in the details around how much actually changes on the ground with how permits are processed and approved. That's really going to be one of the key bottlenecks for getting the rebuild velocity up to a pace that can actually impact the market here in the near term.
Sean, Governor Newsom has talked about cutting red tape. Could you give us some details on that? Give us some real colour. How difficult is it to process the permitting? How long does it typically take?
It can take a while in Los Angeles. It can be many months, and you can go through many different permit comment cycles and get lots of feedback and edits, and there's a lot of red tape. I think some of the things in the executive order that came out recently around suspending CEQA, expediting permitting, preventing price gouging, those are all good and they're in the right direction. But again, the devil's in the details, and we can wave a magic wand on policy as much as we want, but what really matters is how many people are in the permit office actually processing permits. The implementation of these policies is going to be where the rubber hits the road. And we're hoping that a lot more staffing is put into the permitting office.
Sean, I'm just curious if you could give us a sense of how long it would take if we didn't have a permitting process, how long it would take to build a home versus how long it can take given some of the permitting that had been in place.
Yeah, again, it depends on what you're building and how you're building it. One of the things that we're excited by is the potential for offsite construction to help rebuild faster in the impacted areas. And you can put an offsite home in the ground much faster than stick building it, which is how we build here at Villa. So the actual construction timelines can be a lot faster if we deploy offsite construction. And a lot of offsite construction can be pre-permitted in a lot of ways. So that may be an important tool to deploy here to be able to rebuild quickly, using offsite construction with faster permitting and pre-approved plans potentially.
Sean, how much is insurance going to become a sticking point? The idea that insurance costs already were high, they're only going to go higher on the heels of this, and there's a real question about who is going to remain in California.
It's a big issue. It was a big issue before the fires, and it's going to be an even bigger issue going forward. The structure of how the home insurance market in California likely needs to be rethought, and insurance companies need to be able to actually charge premiums that are commensurate with the risk profile in the market, which ultimately means insurance costs are going up. And that raises the cost of housing across the board, whether it's ownership or rentals. Homeowners insurance increases are going to drive the cost up for everybody across the board. And that probably goes up beyond California as well, because the entire market sort of resets to compensate for that risk. So insurance is a real issue here.
Sean, how many calls have you gotten already?
Quite a few. There's a lot of folks in the area looking to rebuild quickly, and given our focus at Villa on using offsite construction to build smaller homes quickly, especially ADUs, we've seen a lot of interest from various clients looking to find ways to rebuild quickly. And we're trying to do everything we can to help. And this is a full court press with our team to find ways to be able to be helpful and get housing back in as quickly as possible. That being said, it's still early. The fires are still going. The fires are still spreading. The winds are picking up today. So it's going to be a while before we actually get to the rebuilding effort, but we're seeing a lot of client demand coming in already.
Sean, there's already a rebuild effort taking place in the southeast. The hurricanes just destroyed houses across several states. Have you already found it difficult to source materials given the rebuild effort taking place elsewhere even before this took place?
Not really. The building products market is more stable than it was during COVID, for example. So sourcing materials has actually not been a big challenge to us yet. We primarily build on the West Coast. So what's happening in the Southeast is pretty far away in terms of the raw material input market. That being said, I think we're going to see some big changes for the cost of both materials and labor in Southern California coming up.
Interesting. Sean, appreciate your time and your perspective, sir. Real experience there. The Villa Home CEO, Sean Roberts, on the latest. A labour-constrained and very expensive market there to rebuild into.
And what you raised, which is the idea that Governor Newsom has talked about potentially pulling back some of the permitting process and removing some of the environmental constraints to expedite possible building. Devil will be in the details. Also a question of how do you create fire-resistant materials to prevent this from happening again?
Well, Sean talked about the changes we might see, and that might be one dimension of those changes. Coming up on the programme, we'll catch up with Venu, Krishna of Barclays, Caso of Wolfe Research, Sonia Meskin of UBS, Tom Tzitzouris of Strategas. The third hour of Bloomberg Surveillance up next, live from New York City. Good morning.
It's going to be a volatile year, and there's going to be a lot of uncertainty there.
All of that policy change is out there for us to sort of take and accept, but I do think it's out there and it is positive in terms of where it's heading.
We don't see inflation accelerating from here like other people. Inflation is going to be demand-driven. I just don't see enough demand.
More towards the cautious side, not the optimistic side.
There are a lot of things out there that I think are going to be adding to volatility, but I don't think that we're headed for a deep correction or a new bear market.
This is Bloomberg Surveillance with Jonathan Farrow. Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
A massive focus on inflation, and it starts this hour. PPI data 30 minutes away tomorrow morning, about 24 hours away, 8:30 Eastern Time. CPI. Then you start to ask the question, how are consumers? How are businesses handling all of this? You'll get some banks reporting on that. JP Morgan, Citi, Wells Fargo and Goldman Sachs all reporting tomorrow morning. Going into it all, equity futures at the moment fading a touch. We're positive by 0.2% on the S&P 500. We did see a little bit of dollar weakness, not seeing much now. Lisa, euro dollar 102.49.
Really, with a non-farm payrolls report on Friday, set up how big of a potential move there could be tomorrow when we get CPI, but even today with PPI, how much this market is on a knife's edge when it comes to a potential inflation surprise that once again gives a sense that maybe not only are rates not restrictive, but they could keep climbing from here with the Fed in a position to be on hold for the remainder of 2025.
A key nugget in Jenny Leonard's Leah Mosin's story about this gradual approach to tariffs is the fact that they want to make sure they can avoid a spike in inflation. Remember, Donald Trump ran on this agenda that he could be the one to bring prices down, whether it's the grocery store, the gasoline, or shopping, everyday goods. That might be a concern that all of that blustering about big tariffs that we heard from other members of his cabinet, soon-to-be cabinet, that actually inflation might be a North Star for this incoming administration.
Stuart Kaiser of Citi talked about how it felt in November. You could bathe in the hopes and dreams of the incoming administration being incredibly pro-growth. Now you have to confront real event risk over the next week. Inauguration on Monday, and then you start to think about policies, sequencing, emphasis, and hopes, again, that inflation truly is the North Star, because if it is, great. And if this is the approach that we're reporting overnight here at Bloomberg, that we'll take this incremental step-by-step phase, 2% tariffs here, 2% tariffs there, use them as a negotiation tactic, that's very pro-risk, very pro-risk. But will we get something different?
We might also be bathing in the hopes and dreams of Scott Bessent ruling the day at a time when he still has to be confirmed by Congress. This week is event risk in itself. And I think some of those nominations that we have coming before Congress are going to be really illuminating in terms of just how much permissiveness there is enough among Republicans to move forward with certain proposals of the Trump campaign versus others. Look, event risk is a hard thing to price. The headline risk is an even harder thing to price. It is all excruciating difficult when you don't even know where you're coming from because people disagree even on the state of the economy as we are right now.
And he's not in the Oval Office yet. He's got to wait a week.
Correct.
It's going to kick off big time next week when we start to see those executive orders.
Yeah, that's why I'm going to take a few days off.
Equity futures on the S&P. You enjoy the slopes. Positive here by 0.2% on the S&P 500. In the bond market, just about unchanged. Coming up this hour, we'll catch up with Venu, Krishna of Barclays, with stocks moving higher on reports of a gradual tariff rollout. Caso of Wolfe Research as Nvidia gets caught up in US-China tensions. And Sonia Meskin of UBS reacting to PPI data. We begin this hour with stocks just a little bit higher. Investors reacting to a Bloomberg report. The Trump's economic team is looking at ramping up tariffs month by month, aiming to avoid a spike in inflation and helping perhaps to put a lid on bond yields. Venu, Krishna of Barclays writing, yields have now entered the danger zone for equity markets, and we are seeing market internals reflect this. Venu joins us now for more. Venu, it's good to see you. Thanks for catching up with us.
Good morning.
If we are in the so-called danger zone, how self-limiting is this move in the bond market?
I think this is a critical phase. I think once we breach the 4.5% rate range, you have to be really concerned. And the principal channel it flows through is multiples. And equity valuation multiples, as we know, have been quite full. Not necessarily rich, but quite full, right? And so the rates risk where the negative correlation between equity and rate kicks in, we are in that territory now.
Why did that correlation change over the past month? In early November, yields were up and stocks rallied. People felt good. Price in a positive growth shock. All good news. What changed?
So there is a sweet spot, a zone in which growth is decent, inflation is reasonably contained, and the market is comfortable with a vigilant Fed. But once you breach a certain point, the concerns start moving towards inflation, deficits, and the likely impact eventually rolling into economic growth as well. So I think it is that changing scenario. So we've been in that zone of less than 4.5 in the 3 3/4 to 4.5 range for quite some time, and that's the sweet spot. But at some point, it starts changing, and I think that's where we are right now. It can move back and forth, as we've talked before, that the rates market has been moving around a lot. And so, if we go towards the 5 range, we have a problem.
If we are in this danger zone, and it is a story of multiples, why isn't it that big tech would be the most vulnerable, since multiples there seem to be the highest?
In fact, big tech is the most vulnerable. The only difference over there is that they had a peak multiple of in the 34 range last year. We entered the year at around 30 times. And so once you start seeing rates go up, anything which is high multiple will get impacted, and that will be big tech as well. The problem is that big tech has been the fulcrum of this market. And when big tech multiples correct, correlations tend to increase with the rest of the market. So it's not as if the rest of S&P is also immune to those multiple changes. Perhaps the correction multiples will be a tad lower, but they're also quite full. So I think it starts with big tech. It gets worse with small caps. It spills into the rest of the market. And multiples alone can cause a 15-20% move in equity markets, and we have seen this before.
But you're still optimistic on the year. You don't see the market going down 15 to 20% in 2025, correct?
Yeah, our full year estimate, we have S&P at 6,600, and that assumes that economic growth moderates but still comes to a very decent level, and that assumes that rates don't take off. And that is one of the principal risks we highlight. Outside of policy risk, rate risk is something we've been talking about on and off for quite some time, citing that empirical evidence of when the trigger starts getting hit.
And this is sort of the ultimate question, and sort of to go where John was beginning, this idea that if you start to see a sell-off in equity markets, people will pile into the bond market, and that'll actually help things. Do you think that actually the nature of this could be different depending on the policy mix coming out of Washington, D.C.? What are you looking at in particular to really inform the sequencing there?
I think what we're really looking for is how the playoff between the two very opposing policy stances are going to actually get implemented. So on one hand, you have the pro-growth side of lower taxes and deregulation squared off against the impact of tighter immigration policies, on the other hand. So when you have, these sort of competing factors, what you want to know is what's the sequencing? How serious are they in implementing it? What is the magnitude of change they're going to have? The pro-growth policy, even deregulation, how is it exactly going to affect different sectors, different stocks going forward? So I think it is these elements, when the new administration comes in, and clearly as we're coming closer to it, it gets more magnified. So far, surprisingly, in the last, let's say, 2 to 3 months, the market has been overwhelmingly focused only on the positive aspects of the pro-growth side. Now we're waking up to the reality that things can be different, right? And you could be living with, like we have been on the view that inflation is stickier. So we will have to stay in the longer for higher sort of rates environment, and that has to reset expectations in the market.
But how much of those good potential policies, pro-growth, we could see from the incoming Trump administration actually changed your view after the election? Because you upgraded your 2025 price target on the S&P 500 after Trump won.
Yeah, so because our view overall over there was that the macro positives still on the margin were outweighing the negatives of the policy risks, right? And so, which starts with the two pillars of economic growth in the US. One is the strength of consumption. Second is the US tech exceptionalism. So both of them in aggregate are still in place. So unless you see a significant crack in that, it's difficult. And mind you, from a fundamental standpoint, we actually see earnings growth accelerating this year, despite all this policy noise, right? So I think the principal channel to be concerned about is more multiples and less so on earnings growth itself, which probably lands in the 12% range this year.
You're upgrading healthcare, but you're negative on commodities.
Yeah.
Why so, especially when we see oil prices rising?
Well, oil prices rising is a very short-term phenomenon. In fact, the bigger story of oil is excess supply and the fact that oil has not indeed reacted to all the geopolitical risks out there. So I think on a day-by-day basis, maybe in the last 2 days it's gone up. The big story is that oil has not been that reactive. And I think that will remain the same. And in terms of talking about negative stuff, in fact, we are negative on staples. These are areas in which you are having waning pricing power, and you have problems on margins and volumes as well.
Wednesday, we're going to start with the earnings season tomorrow. JP Morgan is going to kick off, even though we got Delta earnings on Friday. But I do wonder how much you're expecting to learn about earnings season ahead tomorrow with the kickoff at a time when there's a lot of good news priced into the bank stocks.
Yeah, I think with bank stocks, the problem is that multiples are already well in the close to 100 percentile on a 10-year basis. So I think the market is more than factoring in a pickup in earnings growth. So what really matters now in financials is, are we going to get guidance which is going to cause the consensus earnings number to move up? If not, we have a problem, right? Even in financials. And that's why, if you recollect, one of the things we did, we actually were neutral on financials because it's played out. And now it's a show me on the pure fundamental, which is the earnings growth. Multiples are there. We are pricing it all in.
I remember you said this at the end of last year. We talked about it at a time when a lot of the street, most of the street, that was their favourite sector coming into the S&P 500 coming into 2025.
We've seen this story before, that the higher the bar, the more that anything that's even in line gets punished. And so that's sort of a question here. How do you outperform at a time when everybody is optimistic about you? It's sort of a stressful situation when you're a kid and people think you're going to do well, and then do you really rise to the occasion?
Ramo, live TV, not therapy. You can do this later if you want.
Okay.
Have a long conversation, all right? Deep breath. You know the breathing exercises we talked about?
All right, let's move on.
Krishna at Barclays. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's get over to Danny Berger. Hey, Danny.
Hey, John. Property owners in LA's Pacific Palisades neighborhood are suing the city's Department of Water and Power for not providing enough water to fight the massive wildfires. The plaintiffs claim that a drained reservoir and inadequate water pressure and fire hydrants hindered firefighter efforts, allowing the fire to spread out of control. The fire has damaged or destroyed thousands of structures. The lawsuit alleging that the department's negligence turned homeowners to homeless in a matter of hours. Southwest Airlines is pausing corporate hiring and promotions in order to cut costs. According to a staff memo, the company is also suspending most of its summer internships and some employee team building events that date back to the 1980s. The cost-cutting measures come months after Elliott Management took a stake in Southwest and demanded broad changes, leading to a restructuring of the board. And in sports, the LA Rams defeated the Minnesota Vikings in the final wild card matchup of the playoffs. The Rams jumped out to a 10-0 lead in the first quarter and kept the Vikings at arm's length, with Matthew Stafford throwing for a pair of touchdowns. The Vikings now become the first 14-win team in history to lose the wild card. The game was played at the Arizona Cardinals' home stadium after being moved because of the ongoing fires in Los Angeles. And that's your brief. John.
Danny, thank you. More from Danny again in about 30 minutes. Up next on the programme, we'll get you some morning calls. Plus, we'll catch up with Chris Caso of Wolfe Research on NVIDIA and the recent bout of weakness that stock has gone through. From New York, this is Bloomberg. The opening bout just around the corner, a little more than 1 hour away, 1 hour and 14 minutes. Equity futures negative by, or rather positive by 0.1%, but coming off session highs, well off session highs actually. We were much more positive than this a couple of hours ago. Talk about the why in just a moment. Bond yields are higher by a single basis point, 478.83. And in foreign exchange, the euro was doing nicely, and that move's faded as well. Euro dollars at 102.53 were positive by 1/10%. Had this encouraging report coming from the team at Bloomberg that Trump's economic team was considering taking a step-by-step approach to tariffs, maybe 2% here, 5% there. Faded that story pretty quickly this morning, haven't we?
I have to wonder how much it's overseas traders reading these headlines and saying, oh my goodness, yes, pressing the button, and then the U.S. rolls in and they're like, okay, here we go again. Yeah, exactly. The headline, tit for tat. Hold on a second. We have a couple more days till the inauguration.
The president hasn't seen it. He's not signed off on anything. That was true of the Washington Post report, true of the CNN report, and true of our reporting. We put it in the piece overnight.
So it becomes a really interesting moment where if headline risk becomes something that people fade every time it comes out, How do we know that people are taking certain risks seriously? And that's something that we've heard time and again on this show. Are people taking certain risks seriously at the same time that they have to learn to tune out some of the tit for tat that we're hearing in some competing headlines?
I think a key theme you guys both just talked about is the fact that he is just the president-elect. He's not going to make any decision until he's in the Oval Office. And this reporting is accurate, but it's only from one part of the cabinet that Terry Haines calls these cabinet rivals. But Zero Hedge puts this out, and I think it's interesting.
Sure.
If Trump keeps teasing tariffs the next 3 years, he will force end customers to keep front-running their effect, generating a buying spree across all sectors seeking to lock in lower prices. And maybe he just actually does nothing.
Oh, it's a stimulus program.
Yes.
That's what we're suggesting now.
For who? China?
Next week, exactly. Next week is going to be fascinating. So you'll be at the inauguration.
Yes.
And these executive orders are going to start almost immediately. We'll be at the World Economic Forum. And basically everybody at the World Economic Forum is just going to be looking to Washington, D.C. and responding to it.
Yeah.
That's basically the whole week.
They're all going to be responding to it, but how different it will be than in 2017, right after Donald Trump was elected into office, where everyone said this is terrible, this is not American. This time, we think it's very good. We think that he has the right approach, and if we want to go to Mar-a-Lago, please, we will be there.
Different
and frankly,
attitude.
Completely across the board.
Maybe Davos should actually be in Palm Beach this year. I mean, not to throw some cold water on Davos.
Sure.
But why did they decide to
No, by all means, go ahead.
Why did you do the World Economic Forum the same week as the inauguration and transfer of power in the United States, when we're not sure if Scott Bessent, Howard Lutnick, these individuals are going to have, well, we know they're confirmation hearing, but they then have to be actually voted on and confirmed. Can they even show up at Davos? And these are the people that everyone else in the world wants to talk to.
Usually it's the virtue signaling forum. That's what you go to do. Things are changing, and I think the winds are changing really interesting here. The companies are going to focus on core competency, their customers, their stock prices, and we seem to be parking the virtue signaling. We've seen that from Meta, and I think we've got a hint of that from Starbucks as well in the last 24 hours.
There is going to be a change in tone on that level. That'll be interesting. There's also an increase in deal making, and I think we have to pay attention to that too. There's this feeling that, putting aside all of the feelings, where do we want to go? How do we want to do it? Let's do it. And that, I think, is going to be interesting to hear about.
Equities this morning positive just about by 1/10%. Let's get you some morning calls. First up, Piper Sandler raising its price target on Netflix to $9.50 and keeping an overweight rating, saying the company is a clear leader within streaming. That stock is up by 0.6%. Your second call from Truist initiating coverage on Lockheed Martin with a buy rating, citing its recent pullback as a compelling entry point. That stock also positive by 0.4. And finally, KeyBank cutting its price target on AMD to $150. Highlighting underwhelming demand for its new AI chip. Sticking with the chip makers, NVIDIA caught between the United States and China. The CEO, Jensen Huang, set to visit Shenzhen as Washington slaps new curbs on AI chip sales and Beijing investigates antitrust allegations. Joining us now to discuss is Chris Caso of Wolfe Research. Chris, welcome back to the program. It's quite a sell-off in NVIDIA. I'll give you the context, of course. We have to acknowledge it's quite a run-up as well over the last several years, but we are down about 11% in 4 sessions. Chris, where is that weakness coming from?
Well, obviously, it's been a very good stock for some period of time, so there's probably just some digestion there. One of the things that we've been somewhat concerned about or setting expectations in the first half of the year is simply that supply needs to catch up with demand for NVIDIA. And, we saw a slug of supply come on toward the end of last year. You're starting the new ramp of their Blackwell program now. We think that there's more supply coming on in the second half of the year, and that's where we have expectation for your more meaningful upside estimate. So it's really a question of supply catching up to demand in this very fast-moving market.
Chris, it's great to speak with you, partly because you can parse some of the noise from the signal. And are you saying right now, before we get to some of those delays in the Blackwell chip and others, are you saying that some of the tit for tat between the U.S. and China is more noise right now for NVIDIA shares than some of these other issues?
Right. So today, NVIDIA is selling very little into China directly because of the export controls that are already in place. Some of these new things that were discussed would affect, what they call sovereign AI, which is, the ability of NVIDIA to ship to, third countries and such. And I think there's some concern there that China could potentially use some of those China-friendly countries to park AI servers. And, the purpose of this regulation is to, kind of close that loophole. And it's an ongoing situation. Obviously, there's a new administration coming in. Rules can change, but that's kind of the concern right now. But I think, the bottom line for NVIDIA right now, and what's most important for the stock is just AI demand is very strong and much more than NVIDIA's ability to supply. So the point in which some of these things would concern us more is when supply caught up to demand and they were no longer supply constrained. Then you worry about incremental changes in demand. But that's not the case right now. Supply is well below where the requirement of customers for more AI chips.
In most businesses, this would be an incredible positive, just that demand was so outstripping supply. At the same time, yesterday there was news that a certain Blackwell chip was overheating and actually has been delayed even further, and that caused a number of the big tech stack companies to withdraw orders. How much does that become a headwind increasingly, that if there is this disappointment, companies aren't going to be springing to pay all of this money at a time where their shareholders are getting impatient to see results?
Yeah, on that one, and I can't comment directly about it. It's news from a different source, but I consider that to be, kind of on the order of noise as well. There were some delays in Blackwell actually that emerged over the summer, where they decided to change the mask set and make some changes to the product, and that delayed the launch of Blackwell by a month or two. Really didn't have any impact. Again, it's that underlying thing that demand is so ahead of supply, and there's not really direct substitutes in the market for NVIDIA. NVIDIA's got the vast majority of AI demand. So, to the extent that NVIDIA is tweaking the product and running on these one-year product cycles, the customers are more than happy to wait because of the performance for NVIDIA product. Now, you also have another product cycle coming in the second half of the year, Blackwell Ultra. And what's happened is because Blackwell was a couple of months pushed in the site in their launch, and we're on one-year product cycles. Well, Blackwell and Blackwell Ultra, those kind of product cycles get jammed into one another. That's also in consideration from the big customers saying, do I want to deploy Blackwell? Do I want to wait a couple of months for Blackwell Ultra? These are all kind of things in the mix. But again, that underlying premise that demand is well ahead of supply is what's going to drive numbers, in our view, particularly in the second half of the year.
Chris, just before you go, I'm not going to ask for a bond target. Don't worry. I won't ask about where you think yields should be or anything like that.
Right.
Just looking back over the last several years, Chris, how has the stock tolerated these bouts of high yields? We saw this in 22, in 23, saw a bit of it again in 24. How does this stock typically do?
Well, again, with rates, the concern on tech stocks in general is just what happens to the multiples. So, high multiple stocks as rates change become a concern. For NVIDIA right now, and especially given this pullback, the stock is trading in the 20s in terms of a forward PE. Considering the growth rate of this company, that is a very, very reasonable multiple for a company that's been growing at this rate. So, on that basis, given the relatively moderate valuation here, rates don't concern me very much.
Chris, appreciate your time. Smart stuff as always, sir. Chris Caso there of Wolfe Research on NVIDIA. Does the same logic apply to the likes of Apple and others?
Less clear that the growth trajectory is the same as with the likes of NVIDIA. That makes the multiples harder to justify.
As always, earnings season for me begins at the end of the month when we get the Tech Plays.
So it doesn't
Apple
begin, not with Delta? With the airlines?
Sprinkle of Delta, bit of KP Homes, that kind of stuff.
JP Morgan.
The financials tomorrow morning.
Goldman Sachs.
I find it really boring.
Really?
I do, yeah.
I actually think it's going to be fascinating.
Let's see how fascinating it actually is.
Well,
right?
That's why you're not here.
I'll be here for it. You'll be watching somewhere from New York. This is Bloomberg. Shinali writes in, bank earnings are not boring. That's what Shinali says.
Not. Well, good for you.
It's the fire hose of numbers, I just want to do this after hours, after the closing.
You want to do it after hours around a nice table with a glass of wine.
Warm meal, settle down.
Warm milk.
Read some earnings reports. Equity futures fading going into PPI data. A story just around the corner. That data drops in just a moment before CPI tomorrow morning. Equities just about stable. With those numbers, let's cross over to Bloomberg's Michael McKee. Good morning, Mike.
Good morning, John. Better news off the top, at least, as the PPI headline comes in half of what was expected. The forecast was for a 0.4 gain. It's only 0.2. Core rate comes in flat at 0 after a 0.2 rise the month before. The forecast was for 0.3. And the ex-trade number just up 0.1, same as last month. So where does that leave us? 3.3%. just a little bit higher than it was the prior month, but under the forecast. For core, 3.5%. That's up a tick from the prior month. And for the ex-trade number, 3.3%. So all in all, it appears that this is a relatively good news for the economy and for the Fed. They don't need to worry about inflation at this point, but it doesn't tell them that they need to start raising rates. And so this should be, I would assume, somewhat market friendly. Final demand goods up 0.6 during the month, and final demand services unchanged. So goods was the price increase during the month, and a lot of that was gasoline. So this is all in all a much calmer report than people had anticipated.
Mike McKee, thank you, sir. That was the right assumption. Check out the equity market. As we often say on this program, you can learn something from the data and you can learn a little bit more from how the market responds to it. This market's very jittery about the inflation story. Look at equity futures, almost totally unchanged into PPI and up 0.75% coming out of it. The Nasdaq up by 0.9, the Russell up by 1.4. Check out the bond market. Off the back of this, yields down across the curve. On a 2-year, we're down 2 basis points. On a 10-year, down a handful. We're down 2 basis points or so. 4.75, 74 on 10s. And in foreign exchange, just a bit of a break for the euro and other currencies as well against the US dollar. We take some more heat out of the dollar trade. Euro dollar positive on the session by 0.2%. Lisa, on a little downside surprise on PPI.
What is fascinating to me is that the biggest move is in the equity market right now, bigger than the bond market, which I'm actually surprised about at a time when we're wondering what's driving Treasury yields. I just wonder going forward how much the prospect of another rate hike is what's spooking stocks. And if that's taken off the table, they can keep ripping.
Sonia Meskin of UBS joins us now to help answer those questions. Sonia, good morning.
Good morning.
To see you. How good news is that PPI data from moments ago?
It is very good news, but to be clear, we do actually expect in the UBS, and we have been saying this for a while, we do expect inflation to be temporarily a little sticky in Q1 of this year and then to continue to decelerate.
What is it about Q1s? Because we did this in Q1 of last year. What is it about the first quarter?
It's the seasonals, and frankly, since COVID, really, some of the seasonals have been just off, and we see it in the labor data and we see it in the inflation data.
So how much do you see an actual disinflation that's taking hold? Because the numbers have been very noisy. PPI tends to be something that people look through as not necessarily indicative of what's going to come out with CPI. What do other data really say when you take a look at them?
You're exactly right. So the PPI is actually more relevant for the PCE. Which is in turn quite relevant for the Federal Reserve, right? The Federal Reserve has said many times that they really see the core trend in inflation as the core PCE trend over time. But the CPI is very important. That's what the consumer pays at the register, so to speak. And for the CPI, we do see still an upside for the release this week tomorrow. And that is coming primarily from, just like here we saw an uptick in energy goods prices. We see that also in the CPI tomorrow as well.
What's fascinating to me is that people are trying to wrap their head around the ramifications of the strong dollar. And we've been talking about it with respect to corporate earnings. We've been talking about it with respect to demand for U.S. assets. There's also a question of the disinflationary impact of that when exports and imports in particular have been increasing quite significantly. How much is that a piece of what we're seeing, particularly in data like PPI?
Absolutely. But however, historically, it's taken quite some time for the strong dollar to translate into prices in the United States. And so here we would only really see it so quickly if we saw truly good evidence of a ramp up in imports ahead of anticipated tariffs. We don't really see much conclusive data on the ground on that front to definitively say that this has had an impact.
What do you make of this basically competing narratives we see in the space when it comes to tariffs? Broad-based, ones that may be a bit more gradual. How do you take all of that and put it into an outlook for 2025?
Extremely difficult. The main point I would say of the outlook is that what we're expecting is uncertainty, and the key area to watch for us is business investment and how much this uncertainty around tariffs that businesses have already expressed in some of the survey data is actually going to translate into their investment plans and into their hiring plans.
So everyone is talking about Trump 2.0 being solid for growth. But the fact is, if it's so uncertain, so unpredictable, do you just have paralysis?
Well, potentially, yes, and that's exactly right. And I think the narrative has been shifting, and the narrative has been shifting in part because there is so much uncertainty regarding what the administration will actually do.
So when we look forward, we have, of course, CPI tomorrow, and then we're heading into the administration. We hear we have Inauguration Day and beyond when we start to get a whole host of executive orders. What are you looking for in particular? What could really move the needle for your forecasts?
Well, any certainty around what happens around immigration and tariffs will be very important into our input for the labor market and for industrial production and business investment.
Sonia Meskin of UBS on the back of PPI. PPI coming in just a little bit softer than expected there. And off the back of that, going into CPI tomorrow, equities with a nice lift. We're up by about 0.5% on the S&P 500. Yields are lower by a single basis point across the curve. On a 2-year, we're down to about 4.37. And in foreign exchange, the euro slightly stronger, but not a major move. We're fading a lot of this already. Euro dollar positive by 0.1%. Go back to what I said a bit earlier. This market's very jittery about the inflation story, Lisa, particularly going into CPI tomorrow morning.
Yeah, and it comes at a time where the jitteriness really is stemming from the bond market, which is the reason why I thought it was actually interesting. We just didn't see a bigger move because what we saw on Friday from the jobs picture was a significant shift in expectations in bond markets. PPI tends to be sort of less loved in terms of an indicator. So it's just another noise factor that a lot of people point to ahead of CPI tomorrow.
We were talking about the bank earnings coming out tomorrow as well. Going into the bank earnings, bit of a shift over at JP Morgan, a personnel shift that we need to talk about. The COO, Daniel Pinto, to retire at the end of 2026. JP Morgan naming Jennifer Piepzak the COO effective immediately. Pinto to relinquish duties as of June 30th, 2025, Lisa.
Yeah, and Daniel Pinto, just to remember who he was, he used to be the co-head of global fixed income for the investment bank. He was then the sole head of it. He has been with the bank for many years. He was head of the emerging markets team, et cetera. There's a real question here about whether this is a rejiggering of the deck chairs ahead of a possible succession, or whether this is a question of just trying to consolidate leadership, or whether, after a certain period of time, maybe people actually just want to have lives.
Just confirming as well, Marianne Lake and Mario Dos to continue in their roles. And just to answer, yes, I'm sure that is true. I'm sure Dan Pinto would like his life back. I think that given that new building on Park Avenue is going to be wrapped up in the next 12 months or so, there's going to be a lot of questions asked about succession and whether we're getting closer and closer to the big man making an exit.
We've seen that at a lot of other firms, and that's something that I think a lot of people keep asking at a time where certainly in the private equity sphere, we've seen the changing of the guards in a pretty significant way.
A change over at JP Morgan. The COO, Daniel Pinto, to retire at the end of 2026. We've got this from Jen Piepzak. She will become the COO effective immediately. We get numbers from JP Morgan tomorrow morning. Let's turn to Tom Tzitzouris now of Strategas, looking ahead to the economic data tomorrow morning as well. CPI 8:30 Eastern time. Tom, we just got PPI. How encouraging was that number ahead of the headline inflation read tomorrow morning?
Well, thank you for having me on this morning. But that number is absolutely a breath of fresh air. And we've seen a little bit of a relief rally in the bond market because the bond market really needed it. But we got to see some sort of improvement in CPI as well for the bond market to really start to see yields push a little bit lower. So we still got one more number that we've got to take a look at. But this was certainly a relief to see this come in less than expected.
Tom, do you think that bond yields have been rising because of inflation expectations?
No, absolutely not. In fact, when we look at inflation expectations, they've actually been relatively muted if you look at 5-year, 10-year break-even inflations. What we've seen rising is real yields. Now, economic theory, financial theory tells us that real yields tend to rise for essentially 3 reasons. 1, tightening. 2, inflation volatility, more so than inflation. And 3, supply. Tightening affects the front end of the curve, 0 to 2 years. But tightening really, that is Fed rate hikes. But that really doesn't affect the 10-year part of the curve that much. What's really affecting the 10-year portion of the curve is supply, the concern about Treasury supply, and not just because of future deficits, but because of prior deficits that were pushed into the T-bill market that are now going to have to be scooped and tossed back into the 5 to 10-year portion of the curve. So the market is worrying about all those Janet Yellen T-bills that now have to be refinanced.
So, Tom, do you think that this backup in longer end yields actually has a lot more to go? Or do you think that we're kind of hovering, as people keep saying, in the danger zone that will become a self-fulfilling cycle that will send yields lower?
Well, there's two things here, sentiment and the ability for shorts to continue to pile into their short positioning. Sentiment has clearly been supportive of yields pushing higher because, simply put, look at the jobs report, look at prior inflation data, look at the jobless claim numbers. So sentiment has allowed shorts to continue to come in here. But there's also a phenomenon where there's essentially, if shorts start to get squeezed, then obviously they can't continue to put those trades on. In the cash markets and the futures market, shorts are not being squeezed right now because supply is more than ample to support those shorts. Likewise, in the futures market, in the derivatives market, swaps markets, there's a phenomenon going on where shorts who are putting on curve steepeners continue to be compensated for those trades. So the positions technically are not getting squeezed out, and sentiment continues to support higher yields. So the only thing that's going to break this right now is something on the economic side that tells us that inflation and the labor market are cooling. Today's number helps, but we need more.
Tom, you're critical of the current Treasury Secretary, Janet Yellen. In your note, you're saying that she's leaving Scott Bessent with a bond market crisis, and you point to the massive pace of T-bill issuance. Do you not think we're going to see that pace continue under a Bessent Treasury?
Well, they may have no choice but to continue it for a very short period. But the problem that the incoming administration is going to have is they won't have what I like to call the Treasury's overdraft facility. That is the reverse repo facility, which allowed the Treasury to issue these T-bills without drawing out of bank reserves. That has shrunken from about 2.3 trillion down to 100 billion. So the new Treasury Secretary would love to do what the prior secretary did, but I just don't think they have the capacity to do it. They can do it for maybe 2 or 3 months before they're going to have to start really taking a hard look at raising coupon auctions, which that announcement could come in third quarter with a start to coupon auction increases in fourth quarter. So I think the new administration would love to do that, and they'll do it as long as they can, but they just don't have the runway to do it like the prior administration had because of that reverse repo facility.
If they don't have that sort of runway, what is that going to mean for the bond market?
Well, it means exactly what we're seeing right now. The bond market shorts are going to continue to pile in, sort of like a George Soros type trade where they're going to try to break the Treasury and force them to make some sort of fiscal move towards fiscal conservatism in the near term, because absent that, the curve steepeners have further room to run, or absent a weakening economy. So I do think that we're going to see yields continue to trickle higher, all else equal. If the data continues to come in at expectation, you're going to see the curve steepening, and that will eventually put some sort of kind of roadblock on a very aggressive fiscal expansion in 2025 and beyond. We're not there yet, but shorts have further room to run.
Tom, are you just sitting on a big pile of cash and some gold bars?
Well, you know, the funny thing is, despite the volatility here, we do think that investors are being compensated in terms of, one, the excess yield above not just current inflation, but expected inflation is still pretty attractive here. You're looking at 10s at 470. You're looking at cash at, we'll call it 430 or so. So these are relatively attractive yields. And what's more, investors, for the most part, can inoculate themselves from much of that forward-looking yield volatility risk by doing things like barbells with their treasury or corporate portfolios, or even ladders, a more passive approach. So there's ways to reduce the interest rate risk and to continue to clip that coupon in fixed income, that coupon that's yielding above inflation. So I don't think you need to sit in cash. I think there are plenty of ways to manage this interest rate risk with some curve positioning trades.
Tom, enjoyed the perspective. As always, it's good to hear from you. Tom Tzitzouris there of Strategas, following PPI coming in softer than expected. Tom calling it a breath of fresh air going into CPI tomorrow. Bond yields just about unchanged now. Lisa, we've talked about this a few times, worth talking about again. I'm not sure the bond vigilantes are out to play in the Treasury market just yet. Twos are trading basically in line with where Fed funds are. Mike McKee talked about that yesterday. RBC suggesting that we now believe the Fed has already arrived at their terminal rate for the cycle, so that would make sense for twos to trade here versus Fed funds. Then you look at tens, there's only a little bit of steepness in the curve, 40 basis points or so. Hard to really bang the table and say the bond vigilantes are out to play in the Treasury market. Not to say they won't be, but hard to say they are right now.
Especially if people basically think that inflation is sticky here and growth is pretty good. It becomes this question of, are people just trying to hope that the current rates that we're seeing right now in the market
are going to fade eventually when people see sense? Or is this the new reality? And are people struggling to really get their heads around that?
The opening about 45 minutes away. Equity futures positive by 0.4%, with an update on stories elsewhere, including a little bit of breaking news. Let's get your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. We start with the latest in Los Angeles. Officials are looking into what have caused the wildfires in Southern California. LA County Sheriff Robert Luna says that they're investigating whether power lines owned by Southern California Edison could have sparked the Eaton fire that's devastated Altadena. The CEO of Edison's parent company, Pedro Pizarro, tells Bloomberg that there's no evidence the lines were having any issues. And some breaking news in the last 30 minutes or so. Daniel Pinto, JP Morgan president and COO, is retiring at the end of 2026. Pinto would have been at the company for more than 40 years, and he will continue to serve as vice chairman. Jennifer Pipesack, who is currently co-chief executive officer of the Commercial and Investment Bank, will be the new COO. Traffic in the busiest section of Manhattan fell 7.5% during the first week of the city's congestion pricing plan. The data from the MTA shows that travel times fell on most major crossings into Manhattan. The MTA hopes the plan will continue to reduce traffic even as driving picks up in the spring and summer months. Officials expect to release more data on revenue collection data in the coming weeks. And that's your brief. John.
Danny, thank you. I've been speaking to the cab drivers repeatedly over the last few weeks. We have the same conversation every time we get out of the cab. So, it's quieter. Is it just because it's January and it's cold, or do you believe it's congestion? Getting mixed reactions.
What do they say?
Some people think it's congestion pricing, others just think it's January. My guy yesterday thinks it's just January and it's winter, and things will pick up again in a few weeks' time.
Okay, that doesn't make sense, and I'll tell you why. Because if it were just cold in winter, wouldn't more people want to drive rather than walk? Just saying.
Don't know. Maybe they're just not coming into the city.
People don't go outside when it gets cold. Come on.
Lisa, I'm just giving you the feedback from the research.
Also,
with
February's
no bias.
cold too.
None of my
You
bias.
have to be months away to find out.
It's my daily research, all right?
Okay, actually, I embrace
Bring
it.
you another opinion tomorrow if you come into work. I'll share it with you.
Bummer.
Let's set you up for the day ahead. We'll do that next. From New York City, this is Bloomberg. The opening bell, let's call it 40 minutes away. Equities positive by 0.6%. PPI coming in just a little bit softer, going into CPI tomorrow morning. With some movers, some morning movers, it's Manus Cranny. Hey, Manus.
Jonathan, very good day to you. KB Homes, the very personification of the American dream, home ownership, and it's on fire, quite literally. Net orders soared 41%, revenue of $2 billion. This is the real personification. Buyers continue to demonstrate a desire for home ownership. But here's the thing, even though rates are at 7% for a mortgage, 60% of the orders that they delivered had mortgage concession, and they will continue to use it. A deal on the slate for H&E. You've got United Rentals adding to their portfolio in construction and industrial, paying $3.4 billion in cash, 106%. Oh, to be a share owner in that. I'll leave you a view on Signet. This is the owner of Zales and Jared on the street, the jewelry retail fronts. This is the worst day for them if we open here in 5 years. People are trading down. They're trading down in terms of jewelry and gifts. Jonathan.
Manus, appreciate it. That stock getting hammered down 15%. Just to give you a flavour of what's coming up on the calendar, your trading diary through the rest of this week. Tomorrow, we'll get CPI and big bank earnings kicking off with JP Morgan, Citi, Goldman and Wells Fargo. On Thursday, earnings continue with Bank of America and Morgan Stanley. Plus, we'll get retail sales and another round of jobless claims. And on Friday, we'll get housing starts. We're also keeping an eye on the fires in Los Angeles as firefighters brace for dangerous Santa Ana winds to worsen conditions. Joining us now on that front is Bill Wadell of Accuweather. Bill, give us the latest, please.
Good morning. Yes, we're at a command post with the National Guard and firefighters. We're talking about yet again another rare case of a particularly dangerous situation for a red flag warning that's usually reserved for extreme events every few years, but we've had several in recent months. We are expecting wind gusts 60 to 80 miles an hour in some places today. The big concern is those winds could rekindle or start moving the flames where there's containment with these fires. Also, the threat that ash and embers could be carried miles through the air landing in these neighborhoods. So we've been with firefighters up in the hills where I was yesterday. They were dousing the homes that were spared by the fire, trying to prevent them from catching fire if any of those embers blow into the neighborhoods. But just seeing all of the businesses that were destroyed, the homes lost, I got to tell you, I saw a lot of vehicles, including electric cars, that were destroyed, and those molten metals and debris just all down the streets. We're talking about a massive cleanup ahead once these fires are contained. Accuweather's preliminary estimate for the total damage and economic loss from these fires now at $250 billion to $275 billion. There's going to be a massive ripple effect, economically speaking, not just here in California, but across the nation. Our experts at Accuweather are telling us this is going to make the insurance crisis in high-risk areas even worse, and they tell us that preliminary estimate that may climb once again.
Absolutely devastating. Bill, appreciate your time, sir. Stay safe. Bill Wadell there of Accuweather. Truly a perfect storm. And Bill talked about the economic impact. That's going to distort the data, influence the data, impact it for months to come.
Yeah, at a time when we're already dealing with noisy data, of course, as so many people remind us, that's the least of our concerns. We hope that people are safe, and frankly, we're concerned about some of the embers and what actually is getting burned. Nonetheless, going forward, how do you move forward when you have to pay these kinds of costs for disasters that are incurred around the country, and how much ammunition do you have to really make sure that people can get back to homes and keep going with their lives?
Well, Speaker McCarthy said to me last week, this is going to be a day one priority. When they want to maybe declare the border a disaster, they're going to have to put a lot more money and funds towards towards California. And at the same time, I'm thinking of Florida because people are still dealing with the hurricane effects. We have a lot of crisis right now in this country and a lot of money that's going to have to be doled out.
A big rebuild effort in the southeast, big rebuild effort about to take place in California. If this thing ends sometime soon, and we can actually focus on that, Lisa, but at the moment, we can't.
Yeah, and it raises this question about the flexibility. I mean, after the crisis is over, the flexibility of the labor market. We were speaking earlier with Villa Homes and this idea that how do you hire enough people to actually build those homes at a time where we've already seen shortages on that level? Or on the flip side, are we looking at the potential loss of economic momentum in regions like this? I mean, really, again, talk about the noise coming down the pike.
Already expensive to do it, already incredibly labour constrained, and it's going to be even more so in the months to come, I'm sure. Coming up tomorrow, your lineup looks like this. Gerald Cassidy of RBC will catch up with Liz Ann Saunders of Charles Schwab, Peter Cheer of Academy Securities, and David Kelly of JP Morgan Asset Management. Tomorrow morning, what a morning. You'll hear from JP Morgan and some of the biggest banks on the planet. Then at 8:30 Eastern Time, you'll get CPI inflation data. It's a little bit of everything tomorrow morning, which is why you should all be here, at work, present, logged onto a Bloomberg terminal, and not on a ski slope somewhere in Europe.
I agree.
Bramo, you enjoy yourself.
Thanks, I appreciate it. What a send-off.
I'll see you next week in Europe. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.